Very good morning, friends. So finally, I think this brings us to the end of financial instruments today. A long journey in terms of financial instruments, but yes, at the same time, a very important topic from the examination point of view, and also from the practical aspect point of view as well. So in the previous class, I was discussing with you the concept of derecognition of financial assets and financial liabilities. And then I started the inputs in terms of discussing with you the concept of embedded derivatives. Now, we've done a very basic discussion on the concept of embedded derivatives in the last class. So we've got a total of 3 agendas for discussion today. One is we're going to discuss the leftover portion of embedded derivatives. Of course, before that, I'll just give you a quick recap in terms of embedded derivatives. And then we need to discuss the concept of impairment with you and the concept of hedge accounting with you. So I think let's start the journey. First of all, answering those MCQ questions to you, which I gave you in the previous class. And then I think I'm going to take the journey forward. So I think let's begin the journey, first of all, with those small little MCQ questions to you. So I think let's begin with the first question, though I got a couple of answers in the previous class itself. Now, the first question which I gave you is that if your 10% test, the 10% test is the materiality test which you conduct at the time of strategic debt restructuring of a financial liability. So let's say if the 10% test passes, then in that particular case, it would lead to a derecognition of financial liability. In other words, we can say that the concept of extinguishment accounting would apply. So this is absolutely true in nature. That's absolutely correct. Good morning, Nidhi. Good morning, Sumit. Good morning, Rashmi. And that's absolutely correct. This is 100% true. And I guess the second one is also quite same on that, because it's a version of the first one itself, that if your 10% test fails in terms of materiality test, it indicates that the financial liability will not be derecognized. And this would lead to the concept of a modification accounting. And I think that's correct. Because if you pass a 10% test, it's a case of extinguishment accounting. And if you fail the test, it is supposed to be a case of modification accounting. So I think that is also absolutely correct in nature. Then we come to the third one, where the 10% test is conducted. So now we're not looking at the failure or the passing of the 10% test, but we're looking at that when you're conducting a 10% test. And when you look at this 3-step model, which I gave you, in step number 1, when you calculate the present value of remaining cash flow, we consider a discounting rate, which is original EIR. And when we consider the step number 2 as well, I made it very clear that we need to consider the original EIR itself. So basically, the materiality test is in terms of looking at the variations of the cash flow. So in both the steps, we need to consider the original EIR only. So it's not a new EIR in step 2. The role of new EIR comes into play only when you calculate the fair value of the liability. So in this particular case, the third one is false. And I think I already got inputs on that. Yes, the third one is false. Then the fourth one. Now we're looking at a question on an embedded derivative. So when I'm looking at a hybrid contract, in terms of a hybrid contract, if you are going to sell a PPE in a foreign currency, then we said we are going to enter into a forward contract, which is in terms of buying dollars. And then the fifth one is also exactly based on that as well. And I said that if you enter into a purchase of PPE in a foreign currency, then we need to enter into a forward contract to sell dollar. So I've just intentionally, mixed the two. In case of the fourth one, you need to basically enter into a sell dollar. And in terms of the fifth one, you need to enter into a buy dollar. So that's rightly given. The fourth and the fifth one is also false. But I think we'll just give you a quick recap in terms of the embedded derivative concepts now. Okay, so these questions are answered. Now I think let's take the journey forward. Now we've got some very typical, agendas to discuss for the day. So I think I'm not scaring you at the start of the day, but I'm just, making you comfortable that there would be, certain areas of discussion today which would be slightly technical in between. But of course, I'll make it quite easy for you. The intensity of the topic, of course, is a little technical. So, but we'll still try that, we get very comfortable with the subject. So the issues are not very technical, but yes, slightly technical indeed. So we need to hear this with a good number of patients as well. So let me now start with the concept of what we were discussing. That is the concept of an embedded derivative. Now, last time I said that I've created a three-step model, but I didn't share with you what is the three-step model. Now, let me first of all share the three-step model when you're looking at a derivative accounting. Rather, I would say when you're looking at an embedded derivative accounting, that is when there is a hybrid contract. Now, I am yet to justify why do the standard setters require you to segregate the embedded derivative. I'll be explaining the logic also very shortly. But first of all, let's expose you that if you identify that there is a hybrid contract, you're already aware of the term hybrid contract. When we did Ind AS 32, I gave you that a hybrid contract is one which has got a derivative embedded in it. So when you're looking at a hybrid contract, there is a derivative component in that particular instrument. Like, for example, if you remember, I gave you the concept of an optionally convertible instrument. I said, if there is an optionally convertible debentures for that matter, then I said that it's a compound financial instrument and there is an embedded derivative. The option to convert is supposed to be the derivative embedded in the instrument. So this is a hybrid contract. And in this particular case, depending upon when you conduct the fixed for a fixed test and that fixed for fixed test fails, then in that particular case, you need to segregate the embedded derivative. Now, there is something, which I give you in Ind AS 32. If you recall very carefully, when I made the embedded derivative chart number 5, I hope you recall that I gave you 5 charts in terms of Ind AS 32. And I said that when it is a case of optionally convertible debenture and the option is with the holder, you need to conduct the fixed for a fixed test. And if it passes, then the derivative becomes an equity and it is not segregated. But I never gave you the logic at that stage. Now, today you're also going to get a logic, but not right away. You're going to get a logic very soon today itself. But then I said that if the fixed for fixed test fails in that particular case, then it becomes a derivative financial liability, which needs to be segregated. So you're going to get that pending answer today. So coming back now to the 3 steps. So when you identify that a contract is hybrid, so I would say the very first thing is that you need to first of all zero down on the fact that is it a hybrid contract? Because my accounting for embedded derivative would apply only if you're able to first of all identify that it's a hybrid contract. We'll take a few examples very soon and we'll see how do you identify the contract is hybrid in nature. So the very first step when you look at a question is looking at the identification, is it hybrid? So once you say yes, it is hybrid in nature, then in this particular case, what I would do, I would go to the step number 2 and I would do step number 2A. I will do a step number 2A, in which case this hybrid contract is to be segregated between what we technically called a host contract, which is supposed to be the non-derivative component of the hybrid contract. Mind the words carefully. In the step number 2A, what you need to do, you need to segregate the hybrid contract into 2 components. One is the host contract, which is the non-derivative component of the hybrid contract, and you need to segregate the embedded derivative, which is supposed to be a pure derivative in nature. Since the hybrid contract is a blend of a non-derivative and a derivative element, so basically in step number 2, you need to segregate that what is the host and what is the embedded derivative. So can you connect this with a little example? Okay, so let me remind you The two examples which we did in the previous class. If I take one of the example as a base, like for example, I said I want to buy a property plant equipment, and this property plant equipment is going to be bought in, let's say, a foreign currency, let's say dollars. So I would say this is a hybrid contract. Why is it a hybrid contract? Because the outflow in this particular case is going to vary because of the change in the exchange rate. So let's say, for example, if my functional currency is, let's say, Indian rupee, then I would say that this purchase of PPE in a dollar terms will fluctuate because of the presence of the rate of exchange in that. So once you identify, yes, it's a hybrid contract, the second stage is to segregate the host, which is a non-derivative, and to segregate the embedded derivative. And for the purpose of segregation, if you recall, I had given you the concept of a split. I said the best way is that you write down the transaction and split it into two different components. So like, for example, in this case, when you say that you would buy a PPE in dollar terms, then I would say, let's write the transaction like this, that you're going to buy this property plant equipment, let's say in a functional currency. So let's say Indian rupee. Now, the moment you say that you're going to buy this PPE in a functional currency that is Indian rupee, now there is no derivative in the contract. There is no element of exchange rate fluctuations which will make the cash flows vary. So I would say this has become a host, and we can say this is a non-derivative in nature. But I also told you that if you say that you're going to buy a PPE in Indian rupee, so there is an outflow which we are saying is going to take place in Indian rupee. But there is technically no outflow in terms of Indian rupee. It's like a notional outflow in Indian rupee. So if it is going to be a notional outflow in terms of Indian rupee, then what I need to do, I need to create a notional receipt as well. Because of this particular transaction, there has been a notional outflow. We need to create a notional receipt as well. So I said, imagine that you enter into a forward contract, which should create a transaction in such a way that you get a notional receipt in terms of Indian rupee. So what we said, that you enter into a forward contract, which is for the purpose of selling the dollars. And when you say that you're going to sell dollars, you're going to get Indian rupee, which is like, again, a notional receipt. So the notional payment in terms of buying a PPE in an Indian rupee is offset by a notional amount of inflow in terms of Indian rupee. And this forward contract to sell is basically a pure embedded derivative. So basically, the idea is, the logic will become clear later, but the idea is that I want to segregate the host, which does not contain any derivative component. And the idea is to segregate the derivative so that we are going to account for the host and the embedded derivative separately. I repeat, so that we're going to account for the host and the embedded derivative separately. I hope you're able to catch up with what I am saying at the moment. I know what I'm saying is very technical. Don't worry, I'll consolidate this picture once again, but slightly later. Let me now take to the further steps. So once in step number 1, you've identified it's a hybrid contract. Then you go to the step number 2A, where you need to segregate the derivative and the non-derivative component of the hybrid contract. Then you need to go to the step number 2B. Now, once you segregate the host and the embedded derivative, you cannot outrightly say that, yes, we need to segregate embedded derivative. In step number 2B, what we need to do in this particular case now, we need to now consider in step number 2B, a very important aspect. Ask yourself a question that, is the host, mind the words carefully now, is the host supposed to be an asset, that is 1, and it is an asset number 2 within the scope of financial instrument standard. Now, there are 2 elements to be very carefully seen in terms of the step number 2B. That the host which you identify, is it supposed to be an asset? Now, if you look at buying a PPE, if you say that, yes, you are going to buy a PPE is supposed to be an asset. Yes, of course. And is it within the scope of financial instruments? No. A PPE is a non-financial asset, so it is not covered under the scope of this particular Ind AS. The standard says that if your host is supposed to be an asset 1 and it is within the scope of the standard number 2, then there is no need to segregate the embedded derivative. The standard says that if the host is supposed to be an asset which is accounted under the scope of this particular standard, then since you're already accounting the host as a part of the standard and the embedded derivative is also to be accounted as a part of the standard, there is no need to segregate the embedded derivative. But if I say that it is an asset, but it is not within the scope of the standard, or if I say that it's not an asset and maybe it is within the scope of the standard, or maybe it's not an asset and it's not in the scope of the standard, in all other permutation combinations, the embedded derivative needs to be segregated. Now, this is getting technical. Let me put this once again. So when you go to the step number 2B, you need to put across two questions to yourself very carefully. You need to put across a question number 1, that is the host supposed to be an asset, number 1, and number 2, is it within the scope of this particular standard or not? So if you're able to fulfill both the answers in a yes, that it is an asset. Generally, when you say it is an asset and it is within the scope of the standard, it should be technically a financial asset. In simple words, you can say technically it is supposed to be a financial asset, because assets which are per se under the scope of this particular standard is supposed to be what we can say financial asset. So indirectly, in simple words, I can say that if you've got financial assets, then they are within the scope of the standard. So any kind of embedded derivative which is included in a financial asset need not be segregated. But if you've got anything other than a financial asset, so if you're looking at, let's say, a non-financial asset, or you're looking at a liability, whether it's financial or non-financial, then the segregation of embedded derivative is required. In other words, if I want to make your life a little more simpler, then I would put it like this, that if you just imagine a T-shaped balance sheet, if you imagine a T-shaped balance sheet, we know that we've got non-financial assets in the balance sheet. We've got financial assets in the balance sheet. And we can say that we've got, let's say, liabilities, which are again non-financial as well as financial in nature. So the only area where the segregation of the embedded derivative is not required is a case when you're looking at financial assets. I would say per se, if there are non-financial assets or there are liabilities, whether they are financial or non-financial in nature, there is a need to segregate the embedded derivative. Now, you must be wondering on the logic, but I think we'll come to certain logics later. Right now, I'm just giving you a feel of how do you need to apply these steps. So we can say typically the only area when a derivative is not to be accounted for separately would be a case when you're looking at a derivative embedded in a financial asset. So if you've got any liability, financial, non-financial, if you've got non-financial assets, undoubtedly the embedded derivative is to be segregated. So this becomes my step number 2B. And then we go on to the next step, and that is the step number 3. So once you've identified the step number 2A and 2B, then you go to the step number 3. Now, once you've said that, yes, it's an asset within the scope of the standard, in step number 3, there are 3 conditions which need to be tested for. There are going to be 3 conditions which need to be tested for before you say that embedded derivative will be segregated or not. You need to fulfill all the 3 conditions. You need to fulfill all the 3 conditions before you reach a conclusion that embedded derivative is to be segregated. If any one of the condition also fails, the embedded derivative is not to be segregated. If you're able to fulfill all the 3 conditions, then the embedded derivative will be segregated. I know what you're thinking now. Sir, the last class on financial instruments is getting very, very technical indeed. And our sincere request, can you please repeat and consolidate all the inputs given? I can understand when a person is hearing all these technical things for the first time, it's very scary indeed. But don't worry, let me, I think, consolidate this, then we'll map up this with the illustrations as well. And very beautifully, the entire concept of embedded derivative has been explained in the study material. I'll give you the mapping in terms of how the thought process has been applied and how the flow of the illustrations has been given in the study mat as well. Okay, but so far so good. I guess I am pretty clear in terms of things so far, I guess. Yes, Koshki tells me yes. I hope my other friends are also there with me. Now, let me, I think, consolidate my 3 steps to you. Though I'm yet to give you the conditions in the step number 3, I'll come to those conditions later, but let's first consolidate the picture to you. So I am working on the concept that when a company enters into hybrid contracts, the concept of hybrid contract means that it is containing a non-derivative and a derivative element. So I think the very first agenda, which I think everybody would like to understand, is how do you understand, how do you recognize that this is a hybrid contract? So we'll come to that, but I think I've given you one simple little position in the previous class as well, that when you say that there is a particular contract and there is a component in that contract, there is something in that contract which will make the cash flows vary. So like, for example, I said, if you're going to buy or if you're going to sell a PPE in a foreign currency, so what will happen? The cash flows are bound to vary. The amount of cash flows which you pay to buy or the amount of cash inflows which you're going to get to sell is going to vary because of the fluctuation in the rate of exchange. Now, correspondingly, imagine if there would have been, let's say, a purchase of a PPE in a functional currency, then the amount of outflows to buy or the amount of inflows to sell would have been fixed in nature. The variations in the cash flows would not have taken place. Now, we need to understand the logic that why are we trying to segregate the embedded derivative? Don't worry, that is pending. That I'm going to answer in the next 15 minutes itself. So once you look into the concept of an embedded derivative contract, that is hybrid contract, you need to first of all zero down on step 1. Yes, it is hybrid in nature. So the key test in terms of identifying that it is hybrid in nature is looking at the fact that what is that something which will make the cash inflows or the cash outflows of the contract to vary. So once you're able to say that, yes, there is, let's say, an exchange rate, which will fluctuate the cash inflows and outflow, it indicates its embedded derivative. It indicates it's hybrid in nature. Then you go to the step number 2, and there are 2 sub-steps in step number 2, A and B. In terms of the step number 2A, you need to now segregate the hybrid contract, which is a blend of a derivative and a non-derivative, and you need to segregate that into 2 components. You need to segregate the non-derivative, which is the host, and the derivative, which is the embedded derivative. So continuing with the same example, when you said you're going to buy a PPE in dollar, so we said buying a PPE in a foreign currency would mean that the cash flows will vary because of the change in the exchange rate. So we said, let's segregate the exchange rate. So instead of saying that you're going to buy a PPE in dollar, let's say that you're going to buy a PPE in Indian rupee in a functional currency. The moment you're going to buy a PPE in a functional currency, it would not lead to any fluctuations in the outflow because your functional currency is taken as a base. But the problem is that my company is not buying a machinery in terms of dollar, in terms of Indian rupee. I'm buying it in terms of dollar. So when I'm saying that I'm going to buy the PPE in rupee, it's a notional payment in terms of rupee. And let me tell you, I have not entered into any forward contract as such. The accounting is being done on the presumption. Most important, the accounting is being done on the presumption as if you've entered into a forward contract. We're not entering into any kind of forward contract. The company is simply entered into the contract to the purpose of buying this machinery in terms of dollar. So in this particular case, we split it into two accounting. We say, okay, there's a buying of a machine in terms of functional currency, Indian rupee, that's host, that's a non-derivative. And the other element is a forward contract. Now you need to decide the forward contract in such a way that the notional outflow in Indian rupee is offset by a notional receipt in terms of Indian rupee. So we say, okay, we enter into the contract to sell dollars. So what we're going to do, we're going to give dollars in the contract, and we're going to get Indian rupees in return. So it's a notional forward contract resulting in a notional receipt. So there is a notional outflow in functional currency in transaction 1, and there is a notional receipt in terms of Indian rupee in the transaction number 2, offsetting each other. Then you go to the step number 2B and identify that is the host, number 1, an asset, and number 2, within the scope of the standard. If the host is supposed to be an asset, generally we can say which is within the scope of the standard will be a financial asset. So per se, we can say if it is a financial asset, the embedded derivative is not to be segregated. But if the host is supposed to be a non-financial asset, or it's a liability, financial or non-financial in nature, there will be a need to segregate the embedded derivative. But for this, we need to go to the step number 3. And finally, in step number 3, you need to evaluate 3 conditions. If those 3 conditions are met, the embedded derivative will certainly be segregated, and if not, they will not be segregated. I hope, friends, I am comfortable, absolutely clear, maybe not with all the logics which are still pending, but you're clear in terms of how you're going to apply the application of this 3-step model, right? I hope, I trust I am pretty clear till this particular stage, right? So do give me your inputs on this area so that we can, keep proceeding further. I know it is technical, no denying the fact. Okay. Now further, let's, I think, take this journey forward. And Kaushiki, so when do we go to the step number 3? Well, we go to the step number 3 in a situation when you say that it's not an asset within the scope of the standard. So basically, if it is a case of a non-financial assets, or it is a case of a liability, financial, non-financial, you go to the step 3. The moment it is a financial asset within the scope of the standard, there is no need to segregate ED, and then there is no need to go to the step number 3. Okay. Now, I think before we, go on to a logic of why this derivative is being segregated, I also want to take you to the study material. And I want to show you a very interesting chart which is given in the study material as well. But before that, let's, I think, have a little look at some example on the step number 1. If you look at the study material in unit number 4, that is on page number 12.130. Look at the study material, that is page number 12.150. There is an example 1 to 3, which is giving you examples on hybrid contracts. Look at the very first example. It says company MNL. It says company MNL holds a bond which is convertible into ordinary shares of company Z. So the company has got a bond which is convertible into ordinary shares of company Z. It says the hybrid contract is the convertible bond. The host is the bond asset, and the embedded derivative is the conversion option. Now, if you remember that when you're looking at a convertible bond, we said that the option to convert the instrument is supposed to be a derivative embedded in the instrument. So in this particular case also, a similar example is given that if you've invested in a bond which is convertible in nature, so we can say the bond investment in a bond without an option is supposed to be the host. And you can say the conversion option is supposed to be the embedded derivative. So there are more examples like this given, but that was just a flavor in terms of step number 1. Now let's have a look at a chart which is given in the study material on page 12.130. Now this is the chart which I've given you in the form of a 3-step model. In step number 1, you've identified it's a hybrid contract. Now see, this is the step number 2 in the flow chart. Does the hybrid contract contains a host that is an asset within the scope of Ind AS 109? Do you remember that in my step number 2A, in my step number 2B, I said you need to put across two questions, because step number 1 was it's hybrid. Step number 2A was that there is a segregation of host and ED you've done. Now this is the step number 2B. Does the hybrid contract contains a host that is an asset within the scope of the standard? You can see the two questions. That the host, is it an asset within the scope of the standard? If the answer comes yes, then it very clearly says don't separate ED. So that's what I gave you, that if it is an asset and it is within the scope of the standard, then there is no need to segregate the ED. So this is what I gave you, and I give you a connotation that if you say that it is a financial asset, it would be within the scope of this Ind AS, and there will be no need to segregate the ED, because if you're already accounting the host under this standard and you're going to account the ED also under the standard, then it's a more of a convenience accounting given to you. Then, because segregating the ED can be a complicated task. So in this particular case, the standard has given us a little relief, you can say, that if your host is also accounted under 109 and the ED is also supposed to be accounted under 109, then they've given you a convenience. There is no need to segregate the ED in that case. So segregation of the ED is being practically exempted. So you can say it's a convenience accounting given. Now look at the other side of the chart where it says no. So if you say that it's not an asset within the scope of the standard, indirectly it's a non-financial asset, indirectly it's a liability which is either financial or non-financial, then in that particular case it says separate the embedded derivatives. So basically you need to go to the step number 3 now. And I said that there are 3 conditions which you need to fulfill. And these are the 3 boxes below, which are the 3 conditions of my step number 3. And if you look at the conditions 1, 2, 3, let's have a look at them. EC&R. I'm calling it as EC&R. Now, so what is EC&R? It is called economic characteristic and risk of the ED are closely related to the ECR of the host. Sir, we did not understand what do you mean by ECR of the ED and the ECR of the host are supposed to be closely related. Now, there is a huge guidance which is given in the standard, which elaborates that when the economic characteristic and risk of the ED and the economic characteristic and risk of the host are closely related or not. The study material has also given us illustrations which tell us that how do you evaluate whether ECR is there or not. For the time being, let us consider that we will be very clearly given in the examination that whether the ECR of the host and the ECR of the ED is closely related or not. But the moral of the story is that the ECR should not be closely related. It should not be closely related, because if they are closely related, then in that particular case, we do not segregate the ED. So, but can you throw a light on what do you mean by ECR closely related or not? Okay, let's take an example, friends. Let's take an example, and I think you can vouch me for that. It's a very simple example, and I think you can vouch me on that. Let's say a company issued a bond. Now, please hear this very carefully. I'm going to run through a 3-step model in this particular example. Let's say a company issued a bond. I am issuing a bond. I'm not investing in a bond. My company issued a bond. And this is, let's say, a optionally convertible bond. So my company issued an optionally convertible bond, and this optionally convertible bond is going to be converted into equity shares at the option of the holder. Now, let me ask you something, friends, at this stage. Let me go to my step number 1, then I go to my step number 2A, then I go to my step number 2B, and then I go to my step number 3, where I'm going to look at the 3 conditions. So let's make a walkthrough one by one. The very first question what comes to the mind is this a hybrid contract? Yes, it is a hybrid contract because the option to convert is giving rise to a derivative within this particular contract. So we can say, yes, it is undoubtedly a hybrid contract. There is an embedded derivative and there is a non-derivative as well. Had it been a bond without a conversion option, it would have been a pure ND, a non-derivative. Mind each and every word carefully. If it would have been a case of a bond without any conversion option, it would have been a pure non-derivative. But the option to convert is giving rise to an ED. It is hybrid in nature. Then I go to the step number 2A and I said, okay, let me segregate what is the host, which is the ND non-derivative, and what is the ED. I know the logic in terms of why we're doing this complicated accounting is pending. You'll get the logic very soon. So in this particular case, we say, okay, let's segregate the host and let's segregate the embedded derivative. Now, what is the host? I would say issue of the bond is the host without a conversion. And I would say the conversion option is supposed to be the embedded derivative, that is the derivative in the instrument. Then I go to the step number 2B and I said, is this bond an asset? No, it's not an asset. It is going to be reflected on the liability side of the issuer company. It is not an asset. And I don't need to ask myself whether it is in the scope of the standard, because it has to be a financial asset, then only ED is not segregated. So this is a liability. It's not an asset within the scope. So I go to the step number 3 and start looking at the 3 conditions. Now, let me say something and you vouch me. Can I say, as far as a bond is concerned, it will have a characteristic of a debt. And as far as the option to convert into equity instruments will have equity instruments characteristic. I repeat. As far as the bond is concerned, it has got a debt characteristics. And as far as the option to convert to equity share, it has got equity characteristic. So one of my condition is that the ECR, the economic characteristic and the risk associated with the host and the economic characteristics and the risk associated with the ED are not supposed to be closely related. So we would say that the economic characteristics of the host in this case, which is a debt, and the economic characteristic and risk of the ED, which is supposed to be equity instruments characteristics, is not closely related. The first condition is met. I hope I am making good sense so far. Now, this was the first condition, that they're not closely related. Now, let's go to the next condition. So what do you need to prove? That they should not be closely related. Then you go to the next one. A separate instrument with the same terms as ED would meet the definition of a derivative. Now you need to fulfill that the ED has got all the 3 characteristics of the derivative. If you recall, for a derivative, we've already seen that there are 3 characteristics. One is that you need to say that the value of this depends upon the underlying asset. Number 2, initial investment is negligible or it is 0. And number 3, there is going to be a future settlement as well. So which means that you should be able to prove that this embedded derivative, if it is tested for the 3 characteristics of the derivative, it should have meet all the 3 characteristics. That is a second condition. And the third condition is the entities sometimes, decide that we are going to designate the instrument at FVTPL. We're going to measure the entire hybrid contract and we're going to designate and say that I want to measure this instrument at FVTPL. If the entity chooses to measure the entire instrument, that is the hybrid contract at FVTPL, then also ED will not be segregated. So you need to fulfill the 3 conditions, that is the ECR of the host and the ED are not related. Number 2, the ED has got all the 3 characteristics of the derivative. And number 3, the hybrid contract is not designated to be measured at FVTPL. If the 3 conditions are met, then the ED is accounted for separately. If any one of the condition fails, then the ED is not supposed to be segregated. Then the entire hybrid instrument is measured at FVTPL. So in this particular case, as I said earlier, if you meet all the three conditions, what are the three conditions? You need to look at the ECR of the host, and the ED is not related. The ED has got all the three characteristics of the derivative. And number three, you need to be saying that the company is not designated the instrument at FPTPL. If any one condition fails, don't segregate the ED. The full contract is accounted at FPTPL. And in this particular case, if all three conditions are met, segregate. I know this was quite technical indeed, but I think still that question is coming to the mind. Why are we doing such complications? Why are we trying to segregate the embedded derivative out of this particular contract? What's the good logic? Do you want to know the logic? That why do we segregate this particular portion? Are you interested in understanding the logic, or why is there a need to segregate the ED out of this hybrid contract? What's going to be of help in this particular case? Yes, sir. Of course, we want to understand the logic as well. And okay, Shobham said, so can we take a numerical example for better understanding? Yes, of course, I'm going to do that. As I said, it's going to take a little time. But I said, the things could be a little scary. Now I'm going to take an example. So by another 20 minutes or so, you will become quite clear. I'm not saying 100% clear because you'll have to do a little revision as well, but you're going to get a good clarity. So now let's, I think, bring you to an example wherein I'm going to give you the accounting as well and the logic as well. So watch this carefully. The next 15-20 minutes are going to be crucial. And then I'll give you the logic and then consolidate the picture to you. Because if you notice in the study material, there has been a wonderful illustration given in the study material. And that illustration to me is one of the best illustrations on the concept of ED. I'll tell you which illustration is that. I'm doing a different illustration right now, but you can try that illustration after I am done. And I'll show you which illustration is that. And this illustration which is given is the illustration number 15 on page 12.141. It's a beautiful illustration which explains the entire three-step model and the accounting as well. It takes you on a walkthrough on the entire three-step model along with the concept of the accounting of the ED. Okay, so let me do one thing. I'm going to take a very simple example to begin with you. And I'm taking one of the questions which also came in the mock test paper. This is a question which came in the mock test papers in 2018, and it was there in the study material also earlier. So I'm just going to read this illustration to you, this question number 67 to you, and we're going to understand the accounting, which will give us the logic. Now, next 15-20 minutes, friends, please hear each and every word very carefully, because this is going to build your concept. So very carefully, let's begin the journey. Now it says, on 1st April 17, X Limited, a company incorporated in India, enters into a contract to buy solar panels from Good Associates, a firm which is domiciled in UAE, for which delivery is due after 6 months. That is on 30th September 17. The company X is incorporated in India. So I am indirectly assuming as well, though it's given in the question as well, that the functional currency of X Limited is Indian rupee. And it is entered into a contract to buy a solar panel. And this is from a company which is in UAE after 6 months' time. The purchase price of this panel is in USD. So I am buying a panel in a foreign currency because my functional currency is rupees, and the functional currency, the currency in which I'm entering the contract, is supposed to be dollar. The obligation to settle the contract in dollar has been evaluated to be an ED. He's already told me very clearly that this obligation to settle the contract is a hybrid contract in nature. He's already said it has been evaluated that there is an ED, and then he says which is not closely related to the host. I don't think so. I need to elaborate now. That when he adds on that it's not closely related to the host, he is telling me one of the conditions, that is ECR. that the economic characteristic and risk of the ND and the economic characteristics of the D, that is ED, is not related. And I presume that the other two conditions are met. I presume that the other two conditions are met. So in this particular case, the need to segregate the ED is arising. Now we are given that there is a spot rate on 1st April that is 60 rupees a dollar. 6 months forward rate which is available on 1st April is 65. And the spot rate on 30th September is 66. Now let's begin the journey. So very less focus information is given. We just given a spot rate on 1st April, a forward rate, and a spot rate on 30th September, and you've entered into a transaction to buy the panels at $50 million. Let's begin the journey and let's have a look at how the accounting is going to take place. So have a very good look now. First of all, I'm going to walk through on the accounting part. Now, when I'm going to do the accounting part in this particular case, let me first of all begin with the entries on 1st April 17. Well, on 1st April 17, a company just entered into an executory contract. Mind you, I've not entered into any forward contract as such. So I've just entered into an executory contract where after a period of 6 months, I am going to buy this particular equipment. Now, so what do we need to do for the purpose of accounting? The first thing is there will be no entry done on 1st April 17. So now what we're going to do for the purpose of accounting, we said you're going to buy these solar panels. Let me call it as SP. You're going to buy these solar panels, and this is in terms of dollar. So what do we need to do? We need to do a split accounting, and we'll say, okay, let me buy the solar panels in functional currency, that is in terms of Indian rupees, INR. So the moment you say that you're going to buy the solar panels in Indian rupee, there has been a notional payment in INR. So you need to create a forward contract which will create a notional receipt. And a notional receipt would be that you will enter into a forward contract to sell dollars. So when you go to sell dollars, you're going to get Indian rupee. So there will be a notional receipt. I repeat, I'm not entering into any forward contract as such. So this is the entry which is being done, which is a notional forward contract in nature. Now, we will do the accounting as if we have entered into a forward contract. Now see what I'm going to do. On 30th September, what we're going to do, first of all, we are going to put an entry for squaring of the forward contract. Now, let's get back. Can I say you entered into a notional forward contract, which is to sell dollars at the rate of 65. So you entered into the contract where you said you're going to sell dollars at the rate of 65 a dollar. So you need to square off the transaction on 30th September by saying that you're going to buy dollars at the rate of 66, which is the spot rate. So you would say, okay, I'm going to buy at the rate of 66. So can I say by squaring of this particular forward contract, there will be a loss of 1 rupee a dollar, right? So I'm comparing the notional forward contract that you entered into the contract to sell dollars at the rate of 65. And therefore, you will square off the transaction by buying dollars at 66, resulting in a loss of 1 rupee a dollar. So what do I do? This loss will be recognized in the profit and loss account. So I'll give a debit to the P&L and create a corresponding financial liability. Let's call it as a derivative financial liability. And this will be to the extent of the contract is for $50 million. So we pass this entry with $50 million into 1 rupee a dollar. That works out at 50 million Indian rupee. Right? So this is the transaction which is done in order to recognize the gain or loss on the forward contract, which I have not entered into. So do you think any cash settlements of this contract will take place? What's your inputs on that? Do you think in this particular case, there will be any cash settlement? So if you've not even entered into a forward contract, where would the cash settlements take place? Of course not. Now, you are going to buy the solar panel. Now, let's do the entry in terms of buying a solar panel. So you put the entry solar panel will be given a debit. This entry of purchase of the panel will be recorded in such a way as if you have entered into a forward contract. So in this particular case, the solar panel will be recorded at $50 million into the forward rate, which is supposed to be 65. So we'll be recording this at the rate which is supposed to be the forward rate. But then when you want to make a payment, can I say the payment is going to be made at a spot rate only? Because I've not entered into any kind of contract. So I make a payment and the payment is made 50 million at the rate of 66 when you actually pay the money at a spot rate. So the question now arises, how do I tackle the difference in this particular entry? You already have a derivative financial liability, which is created in the first entry. Just knock it off. And this 50 million into 1 rupee gets knocked off and your entry gets created. Now, I think it's time to say something to you. Now, let me say something. If this clicks, it clicks in a second. Can I say if the company would have entered into a forward contract, they would have actually recorded the asset at the rate of 65? Can I say that extra 1 rupee a dollar, which is paid by the company, is not paid for the acquisition of the machinery? It is not paid for the acquisition of the solar panel, but it is an exchange loss which you have suffered over a period of time. Don't you think so that in this case, what is happening, the panel is getting recorded at the rate of 65 and the fluctuation in the rate of exchange is getting recorded in the P&L? Otherwise, what would happen if you account for this contract just like that you have not entered into any forward contract, you would land up recording the solar panel at the rate of 66 itself. This means you will go in for extra capitalization, the exchange rate difference, which is resulting in a fluctuation in the outflow, gets indirectly capitalized as a part of the solar panel cost. I hope I'm making sense. Since the company entered into a contract, in this particular case, we can say if it would have entered into a forward contract, let's imagine a company which would have entered into a forward contract would have capitalized the panel at the rate of 65. A company which did not enter into a forward contract will actually capitalize the panel at the rate of 66. That means you're giving an advantage to the other company. The company which did not enter into the forward contract will be able to capitalize at the rate of 66. And indirectly, that exchange loss, which has got capitalized, will get spread over in the form of depreciation in the asset to follow. So you're indirectly telling him an advantage that you capitalize what the other company would immediately charge to the P&L. Isn't that going to be an unfair accounting for the company which enters a forward contract and which does not enter a forward contract? There is going to be a different accounting set. So the standard setters thought that to reflect the real cost of an asset, you should technically, consider that you're entering into a notional contract. So the derivative embedded in the contract, which is the fluctuations in the rate of exchange, is being segregated and accounted for separately so that that particular component enters the P&L as an exchange gain or loss and doesn't get capitalized as a part of the cost of the asset. I think if it clicks, I must have been very clear on what I am saying, right? I guess I am pretty clear on this. We've got a couple of questions on this. And Shom says, so why root through financial liability, not directly P&L? You're just creating a financial liability and then ultimately it'll get knocked off when you purchase the panel. And I think Koshki agreed with me. And then I think Koshki said, so why we credit financial liability? Can't we directly take P&L in the second entry? You can. Well, I think if you're thinking in terms of clubbing the two entries, I don't have a problem. This was just to give you an explanation that I have done a splitting of the derivative portion and then I've gone in for a purchase of the panel. You can do a single entry as well. The solar panel can be recorded at a forward rate and the exchange loss on the forward contract can be taken to the P&L directly without creating this financial liability debits and credits. You can pass a single entry as well. So I guess now we made some good logics to you. We've been able to appreciate why are we segregating an embedded derivative. Because if this derivative embedded is not segregated, it would lead to capitalization of the exchange loss as a part of the solar panel cost. So something which is supposed to be charged to the P&L right away is going to get deferred in the form of depreciations over the life of the asset, and that becomes a very wrong kind of accounting. And I think if you think in terms of a huge exchange loss running in crores of rupees, this is going to be a total unfair accounting. I hope you got the logics on that. Okay, got it, Shoham. Okay, wonderful indeed. Now, I think it's time to do a little consolidation on things and give you a little mapping in terms of how the illustrations in the study mat is being organized. So as I said, you'll get the complete logics almost till around 15-20 minutes, around 8 o'clock. So now I think we are ready. Now, I think let me consolidate the picture because I think it's the right time to consolidate things to you. Now, let me take the journey forward with you, and I think let's consolidate the picture. So now I'm going to map up the illustrations of the study material also for your reference, so that once you revise things, you're able to also correlate in terms of which illustrations are devoted to step number 1, step number 2, and step number 3. Now, let's begin the journey. Now, when you look at the concept of a hybrid contract, I gave you a 3-step model in terms of a hybrid contract. And in terms of the 3-step model, I gave you the first thing is to recognize, to identify that this contract is hybrid in nature. Trust me, in a practical life situations, things can become more complicated as well. Because identifying that the contract is hybrid in nature or not could be a complicated task. Fortunately, unfortunately, we've not got any questions in the exam so far where the examiner is telling you to identify the contract is hybrid in nature. But yes, as I said earlier, also, there have been only a couple of 4 or 5 years of examination so far. So we cannot take that as a trend. So we need to learn the larger concept as well. Because you're not only studying from the examination perspective, but you need to be good chartered accountants as well at the end of the day. So the first thing is to identify the contract is hybrid. And for this purpose, I give you that there is a small litmus test which you need to apply. And what is that small litmus test is that you need to basically see that there is something which results in the cash flows to vary. So your basic litmus test would be that what is that something, which will result in the cash flows to vary? Exchange rate presence in the transaction, an option to convert in the transaction. So these could be certain litmus tests which will tell you that the cash flows in the contract will vary. So the inflows or the outflows could vary. That makes it a hybrid contract. Once you zero down in step number 1, it's a hybrid contract. You need to go to the step number 2A and B. In terms of step number 2A, what do you need to do? You need to segregate this hybrid contract into 2 different components. Segregate the non-derivative portion, which is called the host, and segregate the derivative portion, which is called the embedded derivative. So what do you need to do? You need to split the contract into 2 components. One is the host and one is the ED. And then you need to go to the step number 2B and identify that this host number 1, is it an asset and is it within the scope of this particular standard? If you say that yes, it's an asset and within the scope of the standard, which would generally be a case when it is a financial asset, then there is no need to segregate the embedded derivative. A convenience accounting has been given in the standard that if your host, which is non-derivative in nature, and the derivative both are covered under Ind AS 109, the need of segregation is being done away with. But if you say it's not an asset, whether it is within the scope or not of the standard, in that particular case, you need to go to the step number 3. There is a need to segregate the derivative, but before you decide that, yes, I will segregate a derivative, you need to now look at the 3 conditions. And if you pass all the 3 conditions, then only the ED will be segregated. Now, what are those 3 conditions? That's what we need to see. The 3 conditions which you need to fulfill on the basis of which you're going to segregate the embedded derivative is you need to look at the economic characteristics and risk. You need to look at the economic characteristics of the risk, the economic characteristic and risk of the host, and the economic characteristic and risk of the embedded derivative should not be closely related. They should not be closely related. The economic characteristic and risk should not be closely related. The second part is that your ED should have all the three characteristics of a derivative. So whatever characteristics we have done for a derivative, it should have all the three characteristics. So if you consider the embedded derivative and evaluate whether that embedded derivative has got all the three characteristics of a derivative, we should be able to say a yes. And the management is not decided to measure this entire instrument at FPTPL. They should not have taken a decision that we're going to measure the entire hybrid contract at FPTPL. So if you're able to fulfill all these three conditions, then the embedded derivative is to be accounted separately. We will segregate the embedded derivative, and that's how we function. And we've also now got the logic of why this is to be segregated. Now let's have a look at the mapping in terms of how the study material has been arranged in terms of things. So I think now let me just give you a mapping in terms of how things are done. And there has been some beautiful inputs which are given in the study material in this case. The section of embedded derivatives starts in the study material at page 12.130. Now, in order to revise things, you can see example 1 to 3, which are given, is relating to the step number 1. So when you go to the page number 12.130, let me just map this for your easy reference. So when you're going to go to the page number 12.130, I covered one example. You'll see 3 examples which are given, and these 3 examples is giving you a flavor of what kind of hybrid contracts are there. Now, after these examples are done, an illustration 9 is also given. So you could look at the illustration number 9 as well. And if you look at the illustration number 9, it will give you whether it's a hybrid contract or not. Then after this particular illustration, the concept of, you can see 4.2.2 starts where the journey in terms of ECR starts. Now the illustration number 10, the illustration number 11, the illustration number 12, the illustration number 13, and the illustration number till 13. So illustration 11 to illustration number 13, 10 to 13. So illustration number 12 to 13 in the study material is actually devoted to this part. This is going to give you, illustration number 10 to illustration number 13. You know, if you look at these illustrations, some of these illustrations are complicated, but this is just to give you a flavor in terms of one, how do you decide that is it closely related or not? I'm not getting into these illustrations because they've never come in the exams, but this is to give you a more appropriate understanding of the subject, that how do you make an assessment? But let me tell you, these are not exhaustive list because the things can go on and on. But a flavor has been given in terms of taking a decision whether they are closely related or not. So these are the illustrations to give you a better understanding of the concept. Then after that, illustration 13 is done. Then there is a very interesting illustration which comes at the right time. Though I have not discussed that, but now I'm going to give you a flavor of illustration 14. Now, before illustration 14, let me also map it further. Then finally, what has been given is the illustration number 15, and that's where the entire things end. The illustration number 15 is supposed to be a comprehensive illustration which explains the 3-step model which I gave you and also explains the accounting for this. I've already given you the accounting, but this is a comprehensive illustration which gives you the inputs in terms of the accounting as well as the 3-step model. That is how the study material has been organized. But in between, there is an illustration 14 which is given. Now, what is that illustration 14? Now, let me tell you something very interesting on this. Okay, Shomam, you said so the management has got a discretion to decide whether to recognize FPTPL or not. Well, I would say it's not purely a discretion. Designating the instruments at FPTPL has certain conditions as well. It's not always supposed to be a free choice. So I would not say that it's a free choice. All I would say it's a conditional choice. There are parameters on the basis of which you'll designate the instruments at FPTPL. But I'll not get into those details that what kind of parameters are there considering the examination perspective. Okay, now let me come to a very interesting phase, what illustration 14 is all about. Now, I think the most important question which I'm discussing at the last class of financial instruments with you is that when you look at the standard on financial instruments, the question what comes to the mind is a non-financial asset covered under the purview of the standard or not? Do we cover a non-financial asset under the purview of financial instrument standard? Now, you would say, what do you mean by this, sir? You would cover a non-financial asset under the purview of the standard doesn't make any logical sense. I'll now make sense out of it. If we read the scope of the standard, now hear me very carefully. If you read the scope of the standard, you know what it says. If a company enters into a contract, to buy or sell a non-financial item, if a company enters into a contract to buy or sell a non-financial item, it can be under the purview of the standard. So can you take an example? I'll take an example, friends, to illustrate this picture to you. Now imagine there is a company, let's say XYZ Limited. Imagine there is a company XYZ Limited. Now hear this very carefully. It's a very crucial concept which is given in illustration number 14. Now there is a company XYZ Limited, and let's say it makes coffee. Let's say this company XYZ Limited makes coffee that is a finished product for them. And for the purpose of making coffee, they need cocoa beans. Let's say they need cocoa beans for the purpose of manufacturing this coffee. So this becomes a raw material to them, and the coffee becomes a finished goods to them. So we can say it's an inventory. The coffee as well as the cocoa beans, both are supposed to be inventory for them. And I think I can definitely say that inventory is supposed to be a non-financial asset. So when I'm looking at inventory, it is undoubtedly a non-financial asset in this particular case. Now, let's take the example further. Let's say company XYZ enters into a contract on 1st April 21 that they want to buy cocoa beans, let's say on 30th September 21. The company XYZ entered into a forward contract in order to buy, let's say, cocoa beans on 30th September 21. So they entered into the contract on 1st April, and which is to be executed on 30th September. Now, the standard very clearly says that if a company is entering into a contract to buy cocoa beans, technically it is entering into a contract because it's inventory for them. But it says you need to now prove 3 conditions to me. I will not bring these forward contracts as a part of Ind AS 109. Because generally, when you enter into any kind of derivative contracts, whether it's a forward contract or it's a futures or an option contract, generally you would be under the purview of Ind AS 109. But the standard says, I will not bring your forward future contracts under the purview of this particular standard if you can prove me 3 conditions. The condition number 1, that when you entered into the contract, you were very clear that you're going to take a physical delivery and you will not do a cash settlement. If you enter into a derivative contract with the intentions that you will take a physical delivery, I will not bring your derivative contract under the purview of this standard. And you had a physical delivery, you had a, your intentions was to take a physical delivery at initial, and the concept of physical delivery should not change even on the balance sheet date. You were committed when you entered the contract that you will take a physical delivery. And even once you're sitting on the balance sheet date, there is no change in intentions. You still plan to take a physical delivery. And the third condition is the quantity for which you entered into the forward contract should be based on your expected usage. The quantity which you entered into as a forward contract is based on the expected usage. You need to genuinely prove me that you entered into this contract for your own use. There was no speculation objective when you entered the contract. So this is what we technically call an own use exemption. So let me put it once again. The standard was very clear on the concept that if a company is entering into any kind of derivative contracts, per se, you should be covered under the purview of Ind AS 109. But the problem is that if you enter into a derivative contract and it is accounted under Ind AS 109, you will be applying the concept of FVTPL. You would be applying the concept of a fair value accounting, and every changes in the fair value is going to be rooted in the profit and loss account. So companies would enter into certain contracts where the intention is not to speculate, the intention is not to cash settle, but they would like to do a physical delivery settlement because they've got a genuine need in terms of buying, let's say, for example, cocoa beans for the manufacture of FG. So they gave an exemption that certain derivative contracts, when they are entered into with the own use, will give them the exemption. But what is important is that there are three conditions which you need to fulfill. When you entered into the contract, the physical delivery should be absolutely clear. Your intention should be a physical delivery. When you sitting on the balance sheet date, you need to be again very careful that physical delivery concept doesn't change. When you enter the contract, physical delivery was on the agenda. Even on the balance sheet date, physical delivery is on the agenda. Any change in the intention will bring your contract under the purview of Ind AS 109. And the third condition is that the quantity for which you entered into the forward contract is based on the expected usage. So which means if in the given example, I say that this company XYZ enters into a purchase of, let's say, 200 kgs of cocoa beans, I will put across a question to company XYZ, do you plan to take physical delivery? He says yes. On the balance sheet date, I again make a review and I said, boss, you're going to take a physical delivery? He says yes. I said, okay, now tell me, when you entered into the contract, what is your expected usage? Looking at the past usage of the company and looking at the projected sales and everything, I realized that the company's expected usage is, let's say, only 120 kg. I'll say, boss, you're entering into a contract which is more than the expected usage. You cannot be covered under this standard. You will be covered under 109 because your quantity of the contract is not in accordance with the expected usage. If the company XYZ is able to prove me that yes, 200 kgs is in accordance with the expected usage, you are covered under the purview. You are exempted under the purview of 109. So there could be a lot of permutation combinations. If you enter the contract for a physical delivery and later the intentions change to do a cash settlement, you come to 109. If, let's say, for example, you entered into the contract for a cash settlement and later the intentions change to delivery, you're still under 109. So once you are covered under 109, there is no exit. So if you decided that there will be a cash settlement and later, even if the intentions change to physical delivery, you cannot be given an exemption from 109. To avail the exemption of accounting of this derivative under 109, the company need to prove the three conditions and strict conditions that you should intend to take physical delivery when you enter. You should take a physical delivery. Intention should not change at any balance sheet date. And finally, the quantity for which you entered into the contract also needs to be considered as well. So in between, what is given in the study material is that illustration number 14, where they give you three different kinds of contracts. And these contracts are to buy or sell non-financial items, and they are asking you that whether these derivative contracts are within the purview of Ind AS 109, or are they given an exemption because they meet the three conditions of what we call an own use exemption. I hope, friends, I have clarified myself to that extent. Okay, so that's wonderful indeed. So this gives me the entire ambit of the concept of embedded derivatives. So I have given you a crux of all the accounting on this. I think we'll come to illustration 15 if we get time, because I do not take a risk in terms of leaving anything for the time being. So I think I'm now going to go to the next section with you, which is on discussion on impairment, and then followed by hedge accounting, if time permits, which may not be possible, I guess. Otherwise, I would have done illustration 15 as well with you. But I think whatever understanding I've given you, the accounting I've given you, I don't see any challenge that you will not be able to do illustration 15. So you can easily manage that as well. Now, I think let's change the flavor. And I think now let's go to the next section with you, which is again a very interesting section. And this is something that people really have a little fear of understanding as well. Okay, so let me start the journey in terms of my next section called impairment. In fact, recently in the exams in November 22, you would see there was a question which came for the first time on the section of impairment. Now, hear me very carefully in terms of what I'm about to tell you, because this is again a very tricky kind of a section. And if you ask me practically, impairment is one of the most technical things which a company and auditor would do. But from the examination point of view, things are not that complicated, but I think will still give you a good crux of things. So let's begin the journey. Now start hearing me very well, because I'm going to make it very simple for you. But you need to hear me very carefully in terms of what we're discussing. So we're discussing the concept of impairment. Now, first of all, let me tell you one thing, that when you're looking at impairment, I would say that there are two types of assets. I think, first of all, if a question comes to mind that what is impairment, impairment is nothing but, you can say, a fall in the value of the asset. The risk of the fact that the amount may not be recovered. For example, that there might be a bad debts on a trade receivable. It would result in a fall in the value of the asset. So this is what we can say is impairment. If you look at impairment, there are basically two standards in terms of impairment. One is Ind AS 36 and one is Ind AS 109. And interestingly, Ind AS 36 is called also impairment. If you look at the name of Ind AS 36, it's called impairment of assets. Ind 109 has also got a section called impairment, but the difference between the two standards is that Ind AS 36 technically deals with impairment of non-financial assets, and Ind AS 109 technically deals with the impairment of financial assets. So there are two different standards dealing with the concept of impairment. One is 36, which talks about impairment of a non-financial asset, and Ind AS 109, which talks about the impairment of financial assets. But let me also tell you something very interesting at this stage. Though on a very apparent front, Ind AS 36 talks about non-financial assets, but there are certain financial assets which are covered under the purview of 36. And there are also certain non-financial assets which are covered under 109. So the concept is very simple, that when we're looking at 36, it's a standard meant for impairment of non-financial assets. And 109 is meant for impairment of financial assets, but there is an exception when certain financial assets impairment is covered under the purview of this standard. I think I spoke on that earlier as well, but I'm just trying to recall and give you the inputs once again. If you remember, when we were looking at investment in equity instruments, when we were looking at investment in equity shares of a company, I gave you at that time that investment in equity shares could be in terms of related party, or it could be in terms of unrelated party. So when you make an investment in the equity shares of a company, it could be a related party investment. For example, if you invest in a subsidiary, for example, if you invest in a joint venture, for example, if you invest in an associate. Now, investment in equity instruments is a financial asset. So when you make investment in equity shares, it is undoubtedly a financial asset. But if it is a related party investment, then Ind AS 109 is not applicable. The investment in related parties is not covered under Ind AS 109, and I give you that it is covered under Ind AS 27. And Ind AS 27 tells me that this investment can be taken either at cost or it can be taken at a fair value. The company needs to decide an accounting policy choice. Now, if you consider the cost of this investment as per Ind AS 27 at cost, then it is subject to impairment. It is subject to impairment, and this impairment will be covered under Ind AS 36. So if you got investment in a related party, if you got investment in a related party equity shares, in those particular cases, it is a financial asset, but it is not covered under the scope of Ind AS 109. Ind AS 109 says that we are not covering this investment in our standard. So Ind AS 27 lies, and Ind AS 27 says you need to measure the investment at cost or fair value. So if you measure the investment at cost, it becomes subject to impairment testing. And if it becomes subject to impairment testing, being a financial asset, the impairment is covered under 36 because this investment was scoped out of 109. So even the impairment testing cannot be conducted under 109, and this investment is covered under the purview of Ind AS 36. But if it is an unrelated party investment, it is definitely covered under 109, in which case impairment technically doesn't take place. That I'll make it clear further, but impairment would not take place. And even if this related party investment is taken at a fair value, you again come back to Ind AS 109. Impairment testing would not be required. So basically, if investments in unrelated parties are there, impairment technically does become applicable. Even if it is a related party investments taken at a fair value, impairment is not applicable. The only case when impairment becomes applicable is when it is a related party investments taken at cost as per Ind AS 27. So that's one exception. Now, let's give you another exception as well. As I said, even in terms of Ind AS 109, per se, it covers financial assets, but then there is an exception where there is a non-financial asset, but it's still covered under the impairment testing of 109. And one of the exception is what we call a contract asset. Well, once you go to do Ind AS 115, you'll come to know what is a contract asset. A contract asset gets created by virtue of Ind AS 115. Now, that's a non-financial asset, though it is a non-financial asset, but its impairment testing is covered under Ind AS 109. So we can say that, technically speaking, at a very generic level, that when you look at a non-financial asset, it's covered by 36. When you look at a financial asset, it is covered under Ind AS 109. But I also give you an exception that there is a financial asset investment in a related party equity share whose impairment is covered under 36. There is a non-financial asset, which is a contract asset created by virtue of Ind AS 115, on which the concept of Ind AS 109 applies. I guess I'm pretty clear till this particular stage. Okay. Now, with this inputs, now let's take it further. Now, what I've done for the ease of convenience, even in terms of impairment testing, I have translated the entire impairment under Ind AS 109 in terms of my three-step model. So I have created a simple three-step model in terms of impairment testing under Ind AS 109. I'm talking of Ind AS 109. When you conduct the impairment testing for financial assets or the exceptional contract asset. Now, first of all, let me tell you that Indus 109 talks about what we call an ECL model. It talks about an expected credit loss model for the purpose of testing impairment. Now, the step number one is you need to first of all decide that is the given asset within the scope of the standard. You need to first of all decide. I'll make a little more walkthrough on step number one, but I'm just giving you first of all an overview of the three steps. So at the first instance, what you need to do, you need to identify that is the given asset within the scope of the standard. So if I say yes, I go to the step number two. In step number two, what do I need to do? I need to basically, rather, I would say in step one only, what I will do in this particular case, I will also decide the approach. I will also decide the approach for impairment testing. The standard has given us two approaches in terms of impairment testing. One is what we call a journal approach, and the other is what we call a simplified approach. So we need to see that if the asset is within the scope of the standard, then do we apply a simplified approach or do we apply a journal approach? We'll come to the details later, but we're just giving you the step number one. After the step number one is done, you need to go to the step number two and you need to do a study of the changes in a credit risk. You need to do a study in terms of changes in the credit risk. Don't get worried on what is this change in the credit risk. You need to basically see that is there a significant increase in the credit risk or not. So I call this test as SICR. I call it as a significant increase in the credit risk. Now, don't get worried on what is this ICR. We'll understand that. So we need to evaluate that is there a significant increase in the credit risk or not. And then finally, in terms of step number three, we're going to create a provision for the impairment, which is technically called creating a loss allowance in the books of accounts. Technically, it is called creating a loss allowance in the books of accounts, that is creating a provision for the expected impairment which will take place. So let me put this again, and then I think I'll start digging these three steps with you. So the standard tells me that when I am conducting an impairment test, I've converted this into a simple three-step model in terms of application. The first step involves two sub-steps. You need to first of all see that the given asset in question is within the scope of the standard or not. And then you need to decide that what approach are you going to apply in terms of impairment testing. There are basically two approaches, though technically if you ask me there are three approaches, but basically we can say two approaches. One is called a journal approach. One is called a simplified approach, though there is a third approach also, which is called a POCI approach, which is called a purchase originated credit impairment. But we're not going to get into that because that's just been a little theoretical discussion, even in the study. So we're not going to get into the third approach. Then after the first step is done, you've decided that, yes, this is the approach to be applied. You go to the step number two. We need to conduct a test, which is called an SICR. This is called a significant increase in the credit risk. And then finally, after you've decided things in step two, you step number three, and we create a provision for the expected loss. Now, I think let's dig this further. Let's, I think, go on to a little more detail on each of these steps one by one with you. So let's give you more finer details on this three-step model. So let me come to the, first of all, the step number one. So as I said, in step number one, you've got two sub-steps, A and B. Now let's look at the sub-step number 1A. That is, we're looking at the scope. So per se, I said that you're going to cover the financial assets, and you are also going to cover, you can say, certain non-financial assets, and the only exception I give you is a contract asset. It is supposed to be a contract asset. So you've got a financial asset and you've got a contract asset. Now, financial assets, you know, are categorized into four categories. The financial assets are categorized in four categories. One is that they're measured at amortized cost. Second is they're measured at FPTPL. Third is they're measured at FPTOCI, which is with a no recycle. And the fourth is that they're measured at FPTOCI with a recycling. So we can say all the four financial assets are covered under four different measurement categories. So now let's see whether these financial assets will be subject to impairment testing or not. If your financial asset is measured at AC, it is definitely subject to impairment testing. If your financial asset is measured at FVTPL, it is not subject to impairment testing, whether it's a debt investment, whether it's an equity investment. Because you might have measured a debt investment also at FVTPL, or you might have measured an equity investments at FVTPL. So irrespective, impairment is not applicable. Even if the financial asset is taken at OCI with a no recycling, impairment is not applicable, though this relates only to equity investments. Because in OCI no recycling, as I said earlier, nothing can be taken to the profit and loss. So we have excluded it from the impairment testing purview as well. But if you've got FPT OCI with a recycling, impairment testing is applicable because this is applicable to a debt investment. So in terms of a debt investment, let's take a very simple example. There was one small question which came in RTP earlier. Let's say if you look at FPT OCI, let's say you bought this asset at 1,000 at the beginning. So let's say when the asset was initially purchased at a fair value, let's say it was 1,000. At the end of the year, let's say the fair value became 950. So I would take the fair value changes in the OCI. But let's say out of this 50, I identify that out of this 50, let's say 30 is impairment loss. So the remaining 20 relates to other than impairment. So what I'm going to do, if there is an impairment testing done for this particular financial asset, then out of this 50, 30 will be taken to the P&L at the end of the year. So the fair value change, to the extent it relates to the impairment loss, will be taken in the P&L, and the remaining 20 will be taken in the OCI. So basically, when you follow the concept of FPT OCI recycling, the change in fair value of the investment we've seen earlier is taken to the other comprehensive income. But I'll sit down at the end of the year and evaluate that out of the entire fair value change, let's say in my example 50, what component relates to impairment. So out of that 50, if 30 relates to impairment, it will be taken in the P&L. And the remaining 20 is going to be taken in the other comprehensive income. So remember, to the no recycling, there is no impairment testing applicable, but to a recycling, impairment testing becomes applicable. So this is when you enter the step number one, you look at the scope and say that, okay, if it is a FA at AC, apply. If it is a FA at FPT OCIR, apply. And also apply to the non-financial asset, contract asset. Then we go on to the step number 1B. Then we go on to the step number 1B and we say, okay, let's now consider which approach is going to be applied. Now, let's give you a little more insight on the approaches. As I said earlier, that if you look at the overall standard, the standard has given us a total of 3 approaches on impairment. One is called a journal approach. One is called a simplified approach. And one is called a POCI approach. This is called purchased or originated credit impaired. Just to give you a little inputs, that this is financial assets purchased which were credit impaired at the very inception. So when they were originated, when they were purchased, let's say a company made a purchase of financial assets from another company. Let's say I am a company which is to debt securitizations, and I am making a purchase of financial assets of other company. So I know that it is credit impaired at the very initial time of purchase. So there is a separate approach given in the standard called POCI approach, but we're not getting into that. The standard says that there is a general approach and there is a simplified approach. Now let's first understand that what is this journal and a simplified approach, and then we'll come to which assets we'll apply a journal approach and which assets we will apply a simplified approach. But let's first understand the approach. Now imagine on a time scale. Imagine, let's say, a time scale. Let's say this is my time scale. And let's say this is a span of 5 years. And let's say this is the time zero. And let's say this is the end of the first year. So let's say this is my balance sheet date. And this is the end of the fifth year. Now, let's say I've got a financial asset, which has got, let's say, a total 5 years of life. And I am sitting at the end of the balance sheet date. Now, in a simplified approach, mind it, in a simplified approach, I'm not coming to when do you apply a simplified approach, but let me explain what does a simplified approach mean. In a simplified approach, what I need to do, I need to consider sitting on the balance sheet date that what is the expected default which will occur. I need to consider that what is the expected default which will occur over the lifetime of the instrument. A simplified approach tells me that sitting on the balance sheet date, you should consider that if a default occurs, then what is the expected loss which will occur. So a simplified approach asks me to calculate what we call a PD. It is called a probability of default. It requires me to calculate a PD based on a lifetime. So I need to sit on the balance sheet date and I need to calculate that, okay, what is the expected default probability? What is the probability that a default will take place over the remaining life of the entire instrument? Therefore, it is called a simplified approach that you need to consider the probability of defaults over the entire life of the instrument. But if you look at a journal approach tells me that sitting on a balance sheet date, you need to decide that should I look at a default over the next 12 months? Or should I consider the default which will take place over the lifetime of the instrument? A journal approach requires me to take a call that should I look at the defaults which will take place over the next 12 months? Or should I consider a default which will take place over the lifetime of the instrument? Now, one can easily decide that a default over the next 12 months will be slightly less. But if you're looking at a default over the lifetime of the instruments, it could be slightly more. So a company, while using a journal approach, will have to take a call that, should I consider a default over the next 12 months? Or should I consider a default over the lifetime of the instrument? Now, this assessment, whether we are going to use a 12 months PD, that is a probability of default over the next 12 months or lifetime, requires a company to evaluate the changes in the credit risk. Now, what is a credit risk? The credit risk represents the possibility of default. When I say a credit risk, it means that there is a possibility of default which will occur. The other party is not going to pay my money. I am suffering a credit risk. So I need to sit down and see what was the risk of default at the inception. I need to sit down on the balance sheet date and see what is the risk of default on the balance sheet date. If you say that at the inception and on the balance sheet date, there has not been much change in the credit risk. So if I make an assessment and say that sitting at the inception and sitting on the balance sheet date, there has not been much change in the credit risk, then I can use a 12 months probability of default. But if you make an assessment that at the inception and then on the balance sheet date, there has been a huge variation. There has been a huge variations in terms of the credit risk, then the standard says that you should take a lifetime ECL, which means another very important aspect, that if I am using a simplified approach, I am not required to make any assessment of the changes in the credit risk. Because in a simplified approach, I am not supposed to take a call, whether I will take a probability of default for 12 months or a probability of default for a lifetime. I am always considering a lifetime ECL itself. So since in a simplified approach, we don't need to decide that do we take a probability of default for 12 months or a lifetime, it is called a simplified approach. And the step number 2, which is a changes in the credit risk, is no longer required. So if a company is covered under the concept of a simplified approach, then from step number 1, it can directly go to the step number 3. There is no need of making any assessment of the changes in the credit risk. But if the company is falling under a general approach, then the company needs to go to the step number 2, and on the basis of the step number 2 only, they will be able to decide, depending upon the level of changes in the credit risk which have taken place, that do we apply a 12 months probability of default, or do we apply a lifetime probability of default? Right, so this is what we need to do in step number 1A and step number 1B. Then after this, we go on to the step number 2. Don't worry, once we make you walk through more, you'll get more understanding. Now, in terms of step number 2, as I said, you need to conduct a significant increase in the credit risk. You need to basically evaluate that whether the credit risk is significantly increasing or not. As I said, that if you're applying a simplified approach, in that particular case, in a simplified approach, this step is not required, because the assessment of the increase in the credit risk is required only if a company is covered under a general approach. So, but then which assets are covered under a general approach? I'll let you know very shortly. Don't worry. So in this particular case, in a general approach, you need to evaluate the significant increase is there. So if you say no, there is no significant increase in the credit risk, you apply a 12 months ECL. If you say yes, there has been a massive increase in the credit risk, you would apply a lifetime ECL. So, but how do you evaluate whether there is a significant increase in the credit risk or not? Well, interestingly, if you notice, in terms of Ind AS 109, it does not give you any concrete guidance in terms of how you would make an assessment whether there is an significant increase or not. There are a couple of things available. One of the simplest technique of evaluating a significant increase in the credit risk would be, let's say, for example, looking at a credit rating of the instrument. We know that there are agencies like CRISIL, etc., which would give you a credit rating of the instruments. So depending upon the credit rating of those instruments, one could decide. Let's say at 0 point of time, the credit rating was AA. And even at the year end, the credit rating is still AA. So the credit rating remaining constant indicates that the credit risk is not increased significantly. But let's say if the rating was, let's say, a AAA and it moves down to A, for example, then a deterioration or an increase in the credit, increase in the rating could indicate that there is a significant change in the credit risk. So the companies could take, the credit rating of the instruments as a base in order to get the concept that the credit risk changes are significant or not. So if you say that there has been not much increase or decrease in a credit risk, you can continue to take a probability of default based on a 12 months loss. But if you say that there has been a significant changes in the credit risk, then in that particular case, you need to apply a lifetime approach in that case. Further, then finally, we come to the step number 3. So once you've decided for the general approach, as I said, the step number 2 doesn't apply in a simplified approach. So once you've decided the step number 2 in terms of the general approach, then finally, you need to create a provision in the books of accounts. And when you create a provision in the books of accounts, the provision is a multiplication of 3 factors. You need to multiply the EAD, exposure at default. Basically, you can say this is the amount of the financial asset. And you need to multiply this with what we call the LGD. Don't get worried on the terms. I'll illustrate them very shortly. So multiply the EAD, exposure at default, into the LGD, loss given default, and then multiply this with what you call the PD, the probability of default, which you computed in step number 2. For a simplified approach, it is the PD for a lifetime. For a general approach based on the step number 2, you decided it's a 12 months or it is supposed to be a lifetime. And if the time value of money is relevant, we also need to apply the present value factors. We need to consider TVM. Don't worry, step number 3 will elaborate. So basically, we can say the step number 4 is calculating the amount of provision to be created for the impairment loss, which is called a loss allowance. It is a product of 4 factors. The factor number 1 is EAD, exposure at default. LGD is called a loss given default. What is LGD? I'll explain. And the PD, and then the TVA. I know this must have been very scary, but I think you've got at least a basic flow of how the impairment testing is to be conducted. I'll give you a little inputs with examples also, but I think it's time to give you a break as well. I guess you much need it indeed. After which I'm going to illustrate this concept to you with a small little illustration example in the study material as well. Okay, Koshki said, so what is ECC? It's not ECC, it's called ECL. That's called an expected credit loss. I'll make a little walkthrough with you after the break, and I'll give you how this 3-step model is technically applied. How the procedure has been applied in the study mat as well, because the things in the study material is pretty simple. Even the question which came in November 22 is a pretty straightforward question indeed. But I think as of now, let's give you a break, friends, at that. I guess much needed indeed. So let's give you a break now, and then we'll just commence back in another 10 to 12 minutes time. So see you after the break. Welcome back, friends. So I guess you've relaxed your minds as well. So I think now let's do a little consolidation of what I gave you in terms of impairment testing, and we can first, I think, let's have a little more inputs on the step number 3. So first, a quick review on step number 1 and 2, and then a little more detail on step 3, and then we can have a look at a practical illustration to you. Okay, I think Koshki, you got a question. So you said in MCQ 4 and 5, it is false. Will it be true? Please check again and explain. Okay, I'll check that. I'll do that, not an issue, but we'll do it later, not right now. So let me first take it further. So in this particular case, actually, what I did at that time, I just looked at the answer, what was given at that stage, and I just took the answer and just gave the answer. I did not apply my mind. I looked at the answer somebody had given at that stage and it said false. So I said, yes, maybe this is correct. So I didn't really look into that, but we'll see it in the end, not an issue. So now coming back to the picture, in terms of the 3-step model, I had given you a 3-step model in terms of impairment testing. Let's make a quick walkthrough on this. Well, as I said, when you're looking at the concept of impairment testing under IND AS 109, you need to go to the step number 1A and then step 1B. Step number 1 is simply looking at the scope of the standard. So you're looking at all the financial assets which are measured at AC and which are measured at FPD OCI recycling, and the non-financial asset, which is a contract asset, is covered under the purview of this particular standard. Then you go to the step number 1B, and it's time you decide the approach. Now, let's give you a little more insight in terms of the approach. The standard says that when you're looking at a simplified approach, it says that if you've got trade receivable, which has got no significant financing component, it has got no significant financing component. You'll see this in terms of IND AS 115, that there are 2 situations when you make a sale to the customer, there might be a significant financing component in the transaction, or there may not be a significant financing component. So if you've got trade receivable in the books of accounts, which has got no significant financing component, or you can say that we've got trade receivable where there is a financing component, but the company would have applied a practical expedient of not segregating the financing component. Because IND AS 115 also gives us an exception that where there is a financing component, but you decide not to segregate that financing component because it's not significant in nature. So only in a situation where the company has got a trade receivable which has got no significant financing component, or the company decided not to segregate any financing component, a simplified approach can be followed. But let's say if you've got a trade receivable which contains a significant financing component, in those particular cases, you need to decide an accounting policy choice. The company can either choose a general approach or the company can choose a simplified approach. So you can say that in terms of trade receivable, there will be 2 situations. If your trade receivable does not contain any significant financing component, then you are allowed to use a simplified approach. I would say it becomes mandatory. It becomes mandatory that if your trade receivable has got no significant financing component, a simplified approach is mandatory. But if you've got significant financing component, then in that particular case, it's an accounting policy choice for the company. They may choose a general approach or a simplified approach. So leaving this, I can say, and even in terms of lease receivable, the company has got an accounting policy choice. They can use a simplified approach or they can use a general approach. So we can say that leaving the trade receivable and leaving the lease receivable, because in terms of trade receivable, when this financing component is not significant, simplified approach is mandatory. In terms of lease receivable and in terms of trade receivable, when the significant financing component is there, it's an accounting policy choice. But otherwise, we can say that this is a default approach by default. That means if you're looking at a financial asset, which is not a trade receivable, which is not a lease receivable, I would say the default approach is a general approach. So you decide the scope and you decide the approach in step number one, and then you go to the step number two. Now, if you are under a simplified approach, the step number two is not applicable. The step number two does not apply when you use a simplified approach. This approach applies only when you apply a general approach. Now, why does a general approach require the step number two? When you're creating a provision and provision for impairment, the standard is working on not the loss which has occurred. It is not working on what we technically call an incurred loss model, but it works upon the concept of what we call an expected loss model. Therefore, we use the word expected credit loss. It is like visualizing on the asset that what is the expected loss which is going to occur in the future. Therefore, it is called an ECL model. It is called an expected credit loss model. Now, the standard requires that if you use a general approach, you need to see that should we look at the expected loss over the next 12 months? Or should we look at the expected loss over the lifetime of the instrument? So when you need to consider that, do we consider a loss over the next 12 months or do we consider a loss over the next 12 months? This decision would require an assessment whether the credit risk has increased or not. So you need to consider that what was the credit risk when the financial asset was created, and you need to see the credit risk which is there on the balance sheet date, and you need to see that if the credit risk has undergone a change. Now, as I said earlier, the changes in terms of credit risk assessment, there are various number of tools which are used, but I think to understand this from an examination perspective, I gave you a very simple concept that a credit rating of the instrument could be used as a base. So we could see that the credit rating of the instrument at the inception and at the year end, there has not been much change in the credit rating of the instrument. It indicates that the credit risk has not changed significantly. And if the credit risk has not changed significantly, then I think we can consider a default probability, what we call a PD, a probability of default over the next 12 months only. But if the credit rating deteriorates badly and it indicates that the credit risk has significantly increased, because if the credit rating goes down, it indicates that the possibility of default, rather I would say the probability of default, is massively increasing. So this increase in the credit risk will tell you that you need to go on from a 12 months to a lifetime ECL. So the step number two will basically be a decision taker in terms of, do we consider the PD, the probability of default for the next 12 months or a lifetime? In terms of simplified approach, we're in any case considering a lifetime PD. Then I said, in step number three, you just need to multiply the four factors: EAD, LGD, PD, and the time value money. Let's understand the step number three with a little simple example further. Now let's consider that we've got a financial asset in the books of accounts, let's say a loan to the extent of 100 lakhs. Now let's say against the loan, you've also got a collateral security. Let's say against this loan, you've also got a collateral security. And let's say the collateral security is worth, let's say 80 lakhs. Now, we would first of all make an assessment that if this collateral security is sold, let's say if the customer defaults and doesn't pay your money, then you're going to realize this collateral security. So let's consider that if this collateral security is sold, and what's the net amount you're going to realize? So technically in a practical life, we say that there would be a little haircut. A haircut would mean that you will not be able to realize entire 80 lakhs. So let's say after the haircut, we say that we might be able to realize, let's say 75 lakhs. So this is the effective amount I would be able to realize after the sale of the collateral security. Now, in this particular case, if I were to ask myself a question that out of 100 lakhs, what do you think you can recover? I would say my recovery rate is 75%. Because out of this loan of 100 lakh rupees, after selling the collateral security, you would be able to recover, you can say 75%. So indirectly, we can say there is a LGD, a loss given default, which is 25%. So the LGD is supposed to be a concept which is called that if you sell your collateral security and you identify that, okay, this is the net amount I will realize. 75 lakhs is what I can realize from the collateral. So you can say out of 100 lakh, you can recover, this is the recovery portion, you can recover 75%. Which means you cannot recover 25%. So if a default occurs, 25% is what is exposed to default. So in my given example, I can say the exposure at default is supposed to be 100 lakh. The entire value of the financial asset is exposed at default. But considering that if a default occurs, you will be able to recover 75%. So the loss given default is 25%. Now, I'm not going to create a provision for the entire 25%. I also need to consider that what is the probability of default. This probability of default is what you identified. If it was a simplified approach, you took a lifetime ECL. And if it was a case of a general approach, you decided a 12 months or a lifetime ECL. Now, getting this probability of default can be one of the most comprehensive exercises in a practical world. But I can say that from an examination point of view, you can go safe. The PD will be given to you because identifying this probability of default is the main, you can say the main issue agenda in terms of impairment testing. So the examiner is going to conveniently tell you that this is the probability of default. Let's say there is a 2% probability of default. And if I consider the time value of money is not relevant in this case, that is how we get the provision in the books of accounts. So my step number 3 is all about multiplying the 4-factor, the exposure at default, which is the value of the financial asset, the loss given default, which indirectly means what you cannot recover after selling the collateral security as well. And then you multiply this with the probability of default, which means that what is the expected loss if the person doesn't pay in the next 12 months, or if he doesn't pay for the lifetime of the instrument, and accordingly, this is the amount of provision, or we can say the amount of loss allowance in the books of accounts. I think now you would have got a flavor in terms of the 3-step model. Now I'm going to take you to the study material and let's have a flavor in terms of how things have been done. Okay, Sumit, you got a question. If credit rating is downgraded, the need of impairment will be there. Yes. But let me also add something at this stage. There is another side of this impairment testing. Whatever impairment testing we are doing, there is another side of this impairment testing as well. And let me tell you what is the other side. There is a concept which is called a bucket approach. So imagine this is bucket 1. Imagine this is bucket 2, and imagine this is bucket 3. As a part of the ECL model, there is a concept of a bucket approach as well. This is the bucket 1, this is the bucket 2, and this is the bucket 3. Now, the thing which I want to put across is this is nothing to do with the calculation of the loss allowance, but this is to do with the recognition of finance income on the financial asset. So the bucket 1 indicates that the credit risk in this case is low. The credit risk in this case is low. The bucket 2 indicates that the credit risk has increased. And the third bucket indicates that the credit risk has increased so much that the asset is actually become badly impaired. It is something you can say a case of a lost asset. So we can see that the company says that the credit risk is increased. You move from a bucket 1 to bucket number 2. But maybe on a subsequent balance sheet date, you might say that the credit risk actually decreased. Now watch this carefully. Let's say on the first balance sheet date, you say that the movement is from bucket 1 to bucket 2. So at the end of year 1, since the credit risk increased, I decided to apply a PD based on a lifetime. In the second year end, let's say, for example, I move back from bucket 2 to bucket 1. I realize that the credit risk has substantially gone down. Then I will use a probability of default based on a 12 months. That means the assessment of the credit risk needs to be done at each balance sheet date. The company will have to evaluate the credit risk sitting at each balance sheet date and evaluate that if you're moving from a bucket 1 to bucket 2, because bucket 1 considers that you will be covered under a 12 months ECL. The bucket 2 indicates that you're covered under a lifetime ECL. So if you move from a bucket 1 to bucket 2, you are required to consider a PD based on a 12 lifetime. If you move back from bucket 2 to bucket 1, then you are covered under 12 months. So maybe when you assess a credit risk, you say, I'm still in bucket 1. You continue to apply a 12 months. If you move from bucket 1 to bucket 2, you go to a lifetime. You move from bucket 2 or you remain in bucket 2. If you remain in bucket 2, you're in the lifetime. You move from a bucket 2 to bucket 1, you are under a 12 months. So you're not talking about the bucket number 3. Well, bucket number 3 is also a lifetime. So even if you move from a bucket 2 to bucket 3, the concept of PD remains a lifetime. So you move from 1 to 3, you move from 1 to 2, you are using a lifetime. So then what is the difference between the bucket 2 and the bucket 3? Well, the difference between bucket 2 and bucket 3 is that if you are in the bucket number 2, your finance income will be taken on the gross value of the financial asset. But if you are in the bucket number 3, the finance income will be taken on the net amount after the loss allowance, which means that if you are in a bucket number 2 and the bucket number 3, the similarity is that you're using a lifetime ECL. But if you're in a bucket number 2, your finance income to be taken on the financial asset is on the gross carrying amount of the FA. But if you're under a lifetime, if you're in a bucket number 3, then you need to consider the interest income, the finance income on the net amount. You take the value of the financial asset and reduce the amount of loss allowance computed, and the finance income will be taken on the net figure. Otherwise, the probability of default for a bucket 2 or a bucket 3 remains a lifetime. So this is another side of the ECL model, and this has also been given in terms of the study material. If I take you now to the study material in terms of unit number 6, sorry, not unit 6, unit number 2, where the concept of impairment is given. You can see page number 12.79. This is the 3-stage model given, which we call it generally as a 3-bucket model. You can see the stage 1, 2, 3 is like the bucket 1, bucket 2, and the bucket 3. So you look at the initial recognition, the credit risk is low, so you're covered under a 12 months ECL. You go to the stage number 2, the bucket 2, there is increase in the credit risk from a moderate to a high level. You're covered under a lifetime ECL. And the interest recognition is again on the gross amount. You move from a stage 2, a stage 3, that means your financial asset is credit impaired. This significant increase in the credit risk, you apply a lifetime, but the interest now, instead of the gross amount, is taken on the net amount. So you can say that if you are in stage 1, you're covered under a 12 months ECL. You move from a stage 1 to stage 2 or stage 1 to stage 3, you are covered under the lifetime ECL. The PD will be taken accordingly. Either you take a PD for a 12 months or you take a PD for a lifetime. But the only difference is that if you're moving from a stage 1 to stage 2, it doesn't make a difference on the recognition of the finance income on the financial asset. But if you are in stage number 3, it definitely makes a difference on the recognition of the finance income as well. You need to now consider the interest on the net figure. Well, we don't have illustrations giving us, this kind of accounting, but this was just in case. I wanted to give you the bucket approach as well. Now, I think, let me take you to the study material. And okay, I think there's another question, Sumit, coming from you. Okay, no, I think that is already answered. Okay. So now let's do one thing. Let's look at the illustrations in the study mat, how the illustrations have been organized. Well, if you look at the very first illustration, it's a pretty simple and a straight illustration indeed. This illustration is giving you the application, you can say, of step number 3. Everything is given in the question. We don't need to decide whether it is in the scope of the standard and which approach are we applying. And we're directly given information on step 3. Let's, I think, read this to you, and you can see the answer also very simple and straight. Let's read. It says A originates a 10-year loan for currency unit 1 million. So taking into consideration the expectations for instruments with a similar credit risk, the credit risk of the borrower, and the economic outlook for the next 12 months, entity A estimates that loans at the initial recognition have a PD, a probability of default 0.5% over the next 12 months. So at the initial recognition, we made an evaluation of the credit risk, and at the initial recognition, we said that the probability of default is 0.5%, considering a 12 months expected default. Entity A determines that changes in 12 months PD is a reasonable approximation of the changes in the lifetime PD for determining whether there has been a significant increase in the credit risk. So the company has decided that there is no significant increase in the credit risk, so I am continue to apply a 12 months ECL itself. So the credit risk at the inception and the credit risk on the balance sheet date has not undergone any kind of significant change. So the company feels that we can continue with a PD of 12 months itself. LGD is already given 25%. He says calculate a loss allowance, which is like step 3. Now, even if you apply my 3-step model, I would say, is it a case of a financial asset? Yes, it's a loan. And the loan would generally be taken at AC. So I would say it is within the scope, step 1A. Then I go to the step number 1B, and I would say this is not a case of a trade receivable. So I think I'm applying a journal approach. Then I go to my step number 2. Since I'm applying a journal approach, I'll see is there a significant increase in the credit risk? And the question tells me, no, there is no significant increase. So we decided we're using a 12 months PD, a probability of default. Then you go to the step number 3, and in step number 3, you just multiply the 3 factor. Considering that 12 months would not involve a time value of money, you multiply the 3 factors, the EAD, which is the amount of the loan, 1 million, and then the LGD 25% given, and the PD is 0.5%, multiply the 3 factors, you get the loss allowance, the provision to be created. It's as simple as that. I think this illustration must have given you at least a basic flair of things, I guess. Okay, this was the very first illustration given, and then there is another illustration given in the study mat, which is illustration number 43. Let me now illustrate this. Now, first of all, let me tell you that in terms of the approach of impairment, there is another concept which is called a loss rate approach. There is another concept which is called a loss rate approach. Now, what do we do in this particular case? Let me tell you that this is a question which is based on a simplified approach. This is based on a simplified approach. Now, let me give you something more. I'm just giving you a little more inputs on the concept of a simplified approach. The first question was based on a journal approach, and this is based on a simplified approach. Now see what I'm going to do in a simplified approach. Even the question which came in the exam this time was on a simplified approach, because there is a concept of what we call a matrix approach, which is allowed in terms of a simplified approach, specifically in terms of trade receivable. Now watch this. You know, in a simplified approach, we will follow certain steps. Now watch these steps very carefully. You know, like for example, I am considering a provision to be created on a trade receivable. I want to create a provision on a trade receivable. So if I want to create a provision on a trade receivable, what I'll do first of all, I need my past experience. I need my past experience. I need to see that what is the percentage of defaults which generally takes place. So the first one would be that you need to decide what sample data are you going to consider. You need to consider what sample do we consider, because you need to consider a representative sample in terms of what defaults have occurred in the past. So we consider, first of all, okay, let's consider a sample. Let's identify the period in the past. The sample is like identifying the period in the past on the basis of which I will calculate that what was the actual defaults which occurred. Then what I'm going to do, after you've selected a sample, once you've selected a sample, after the selection of the sample, we will now calculate what we call a historical rate. We will now consider what we call a historical rate, because since it is an actual default, you can call this as a historical rate that based on your past experiences, this was the rate of default which was occurring. So this is called calculation of the historical rate. This is basically called a past looking. This is like looking at the past, that you identify a sample, and based on the sample, you look at a historical rate. Then you need to go to the step number 3. And in terms of the step number 3, we need to do what we call a forward looking. We need to do what we call a forward looking in this particular case. Now, the question rises, what is a forward looking? I cannot consider the historical rates as it is, but I need to make changes to the historical rates looking at a forward looking. For example, I will look at the macro factors in the economy. I will look at the industry in which I operate. What is the outlook, economic outlook of the environment in which my company is operating? So we would do a little forward looking, and what we typically call in a practical life is we'll agitate the historical rates. Like for example, if you've got a historical rate of let's say 2%, we'll agitate that bit. Agitate in the sense that we will increase this by a forward looking process. So we will look into the various factors, the factors affecting the economy, and we will basically look at a broader outlook of factors and then do a forward looking and agitate the historical rate and increase it, push it a little further. And then finally, after you've got the forward looking rates, then after that, what you can do, you can create a provisioning on this basis. Now, when you create a provisioning, there will be 2 aspects of creating a provisioning. The first aspect of creating a provisioning is doing a grouping. So one would be doing a grouping because, when you're using a simplified approach, let's say for a trade receivable, we would group, I cannot take every trade receivable one by one. I cannot consider a provisioning for every customer separately. So on the basis of certain risk characteristics, on the basis of certain features of the financial assets, you could do a grouping of those financial assets. So maybe you say that, okay, let's consider a group that all these debtors are supposed to be, overdue for a period of, let's say, 30 days. Or let's say these are the debtors which are overdue for, let's say, another 31 to 60 days. So you do a grouping on the basis of certain characteristics. After the grouping has been done, then finally we create a provision, and this provision will be based on the step number 4 grouping and the forward-looking rates which you identified in step number 3. So I would say in terms of a simplified approach, it becomes a 5-step model. I've just created that 5-step model also for the ease of convenience. That's how we do it in a practical life situations as well. That when you look for a simplified approach, the first thing is getting a representative sample of the past. After you've got the representative sample of the past, from that sample, you derive your actual default rates, which is called a historical rates. And then you need to do an agitation, and you need to do some forward looking, and you need to get the you can say upgradation of the historical rates, looking at the economic outlook and other factors, you would upgrade and increase the historical default rates. And then you need to do a grouping. And on the basis of grouping, we're going to create a provision. So create the groups, the rates to be applied to the particular groups in step number 3, and you get the amount of provision. I think let's take an illustration which is given in the study material itself, which elaborates this particular concept to us. So let me just go back to the study material. And I think in this particular case, let's, give you this input. This is the illustration which actually came in the examination in November 22. I don't know, the figures were not exactly same, but the question was pretty much the same. So I think let's have a look at the illustration 44. This is a simplified approach where we are considering what is called a matrix approach. So we are applying a simplified approach called a matrix approach, which is applicable only to a trade receivable. That way we do a grouping based on a matrix. Now let's have a look. Company M, a manufacturer, has got a portfolio of trade receivable that is 30 million. When you say a portfolio, that means there might be different customers within this portfolio, and operates only in one geographical region. The customer's base consists of large number of small clients. And the trade receivables are categorized by a common risk characteristic that are representative of the customer's ability to pay all the amount due in accordance with the contractual term. I think you would have seen one thing very clear, that he's already talking about the grouping of my trade receivables into various blocks. That is indirectly my step number 4, that the customer base is comprising of various kind of clients, and we have categorized them into various categories by a common risk characteristic. So the company has taken the grouping on the basis of a common risk characteristics and done the grouping. The trade receivables do not have a significant financing component. And as we said that earlier, that you can apply a simplified approach only if the trade receivable do not contain a significant financing component. In accordance with the para number 5.5109, loss allowance is always measured at an amount equal to lifetime ECL. Indirectly is telling me that I need to apply a simplified approach in this case. So I think if I apply my 3-step model, first of all, to go with, I can say step number 1A, is this within the scope of the standard? Yes, it's a trade receivable, a financial asset. And is it covered under the scope of the, which approach am I applying? Well, I would say in terms of approach, it's not with a significant financing component. So I'm taking a simplified approach in this case. I go to the step number 2. Do I need to go to the step number 2? No, I don't need to go to the step number 2, because in this particular case, I'm using a simplified approach and I need the default rate, which is based on a lifetime. Now, let's see what we're going to do. Please use the following data for the information of debtors. So what he has done in the question, he's already given you. He's already given you that this is the grouping which is done. So basically, if you ask me, the grouping has already been given. So the total debtors of 30 million is been divided into various groups. And then he says, use the following rates. Now, if you ask me technically, I have got nothing to do in this question, actually. I've got nothing to do in this question, because if you technically see what I have given you, I had to select a sample, which I don't need to do in this particular illustration. I had to derive the historical rates, which I didn't have to do in this question. I had to do a forward looking, which I don't need to do in this particular question, because he's already given me the default rates expected based on a past and a forward looking. So what do I need to do, friends? I just need to multiply. I just need to multiply the respective debtors in each group with the default percentage. Thank you. So that's all I need to do. So what the answer needs to be given is that you multiply all your debtors with the respective provisioning loss rates given. So it is a simple application of the 5th step, because the examiner did not ask you to select any data, but I was giving you only for a clarity of thoughts. That when you apply a simplified approach, if you look at a practical life scenario, the challenges would be selecting a sample. The challenges would be getting a historical rates. The challenges will be agitating the historical rates into, you can say, after doing a forward looking, agitating the rates. But in this case, we were simply given the grouping as well. And we were also given the default rates after looking the past and the forward, and just multiply and get the answer. As simple as that. But I thought I'll give you the journey at the background of this question. Now, what they did in the study material is they've given you an illustration 43, where they've just tried to give you that based on historical data, we had a certain past rate. So in this illustration 43, they're trying to explain that there was a past rate, and then there has been some forward looking which has been done, and they've tried to derive the forward rates. So you can have a look at illustration 43, what I gave you, you'll easily get that. So basically, there were 3 illustrations given. One illustration was a pure application of step 3. Another illustration 44 was a pure application of the simplified approach, where again, nothing had to be done. And then illustration 43 was devoted in terms of just illustrating you that a company has selected a sample and they have a grouping and they are deriving a past default rate, and they're going to agitate that and they're going to get what we technically call a forward looking, and we get rates on that. So it is pretty easy from an examination perspective as far as impairment is concerned. I hope you've got your full picture. Shubham, yes, got it. Wonderful indeed. Okay, now I guess I am going to take it further, friends. And now we're going to discuss the last agenda in this standard. Though there has been no questions which have come in the exam so far on the concept of hedge accounting. In the study mat also, we are mainly given theoretical inputs on that, but there was one question which came in the RTP. So what I'm going to do, I'm going to first of all give you a little, good idea, so that if a question comes on a hedge accounting, how do you tackle that particular question? So let me give you now exposure on hedge accounting. It can be one of the most complicated tasks in a practical life situations. But again, from the examination point of view, you just got to get a basic overview in terms of how hedge is conducted. Let's have a look now. Now, I am taking it further. And let's, I think, first of all, do a discussion on hedge accounting. Now, in order to make it again convenient and ease the level of understanding, what I have done in this particular case, I have again divided hedge accounting into a 5-step model. Wow. This is for the ease of understanding on a step-by-step basis. I have segregated the concept of hedge accounting in terms of a 3-step, 5-step model. But before that, let's understand what is hedge. Well, there is first of all a very common misconception which people have, and I think I want to first of all clarify on that misconception. We always feel that if you want to hedge of course means to reduce a risk. Hedge of course is always to reduce a risk. We never say that hedge is supposed to be eliminating risk. Well, we cannot be pretty sure in a situation that we can eliminate risk. It's very difficult that you eliminate a risk in a given situation. So like, for example, if let's say it's raining outside and I take an umbrella. So what I'm doing, I am saving myself from the risk of, draining, from drenching. I don't want to get wet. So I take an umbrella and I go out when it's raining. So I am trying to reduce the risk so that I don't get drenched. So what I'm doing, I'm basically reducing my risk. Companies would be exposed to different kinds of risk. Every company is going to be exposed to a different kind of risk. The risk could be in terms of that, the outflows might increase. The risk could be in terms of the inflows may decrease. The risk could be in terms of the fair value fall of an asset. The risk could be in terms of protecting the increase in the fair value as well. So the misconception which people have got is that hedging only means protecting against loss. No, hedging doesn't really mean that you're always trying to protect against losses. Protection against losses is there, but even protecting gains is a part of hedging. A company has got an unrealized gain today and it wants to protect that unrealized gain, they can enter into hedging. A company has got let's say a loss which is unrealized at the moment and they want to protect against that loss. So the idea of entering into hedging can be two ways. You want to protect yourself against the anticipated losses. You want to protect against the gains which are unrealized, but you want to protect yourself. Now, the most important and another aspect of hedging is that it is not mandatory. Hedging is not mandatory. It's a complete choice of the company that they want to conduct hedging or not. It's not mandatory at all. But if a company chooses to apply hedge accounting, there is one important aspect we need to keep in mind. Let's say, for example, if you consider inventory for the purpose of hedging, I want to reduce the risk of the fall in the value of the inventory. I have inventory and I know that I'm facing a risk that the value of the inventory will fall down. Now, I know that in terms of inventory, the measurement principle of inventory is given in Ind AS 2. That is called cost or NRV, whichever is less. But now, most important thing. If you bring inventory under the purview of hedge accounting, then the measurement principles governing inventory will get overruled by hedge accounting. No longer you will be able to take the inventory at cost or NRV. You'll have to consider the inventory at a fair value always, even if the fair value is more or even if the fair value is less than the cost. So the very important aspect is that if you bring a particular item within the purview of hedge accounting, the measurement principles governing that particular item is gone. Now the measurement principles of Ind AS 109 would apply. Now, let me now introduce you to a 5-step model which one needs to understand for the ease of convenience. Now, when I'm looking at the concept of hedge accounting, I have created a very simple 5-step model. So let's have a look at what does my 5-step model say. In step number 1, you need to identify what we call a hedged item. In step number 1, what you need to do, you need to identify what you call a hedged item. Now, what is a hedged item? A hedged item is something which you want to protect. For example, when you look at a hedged item, it can be a recognized asset or liability already in the books of accounts. So you want to protect an already recognized asset in the balance sheet, for example, inventory, for example, a PPE, or you want to protect a particular liability. Or it could also be an unrecognized asset or liability. It could also be an unrecognized asset or liability. Now, when I say it is unrecognized can be of 2 types. Unrecognized can be of 2 types. One is what we call that there is a firm commitment, but not yet recognized. There is a firm commitment, but it is not yet recognized. A company has entered into contracts which will be executed in the future. So you've already a firm commitment. You've already entered into certain contracts, but which are not yet executed. So there is no asset or liability which is already standing in the books of accounts. But I want to still protect myself against those future contracts. Or the unrecognized assets and liabilities could relate to certain assets and liability, or we can say transactions which are highly probable to occur. The transactions are highly probable to occur. They've not occurred so far, but there is a huge probability that these kind of transactions would occur. So the standard allows me that you need to first of all decide the target. The target is what we call a hedged item. You need to basically decide what do you want to protect. Are you protecting an already recognized asset or liability in the balance sheet of the company? Or are you trying to, protect yourself against an unrecognized asset liability, which stems out of 2 kinds of situation that you've already entered into contracts to be executed in the future. So there is a firm commitment. You've already entered into the contract, but there is no asset and liability appearing in the books of accounts. Or it could be a situation when you are entering into, that the transactions are not yet entered into, but there is a huge probability, a very high probability of these transactions which are going to happen in the future. My company is planning to buy a machine. I've not yet bought a machine. I've not yet entered into a commitment contract to buy, but it is highly likely that I will buy a machine. And I know since I'm going to buy the machine in a foreign currency, for example, so I want to protect myself against the huge outflows which will take place because of the exchange rate going back. So this is my step number 1, getting what we call a hedged item, looking at the target which you need to protect. Secondly, the step number 2 is looking at what we call hedging instrument. The second is looking at what we call a hedging instrument. Now, when I say we are looking at a hedging instrument, the hedging instrument means that you are looking at the tool. You're looking at the tool with which you'll protect your hedged item. You want to protect the item. So what kind of tool are you going to use to protect that item? And generally, the tool which is used is called a derivative. The company would generally use a derivative for the purpose of protecting the hedged item. So you need to decide 2 things in step 1 and 2. You need to decide what do you want to protect. That's called a hedged item, and the tool with which the protection will take place. So in my example, if I look at a layman's point of view, there is rain happening outside. So what do I need to protect? I need to protect my body from, getting drenched. So I would say I am the hedged item. And I use an umbrella for the purpose of the fact, so that becomes a hedging instrument. So what you want to protect is the hedge item, and the tool with which the protection will be done is called the hedging instrument. Third, there is a very important factor which is given in the standard, and they say that you need to go in for a formal documentation if a company wants to apply hedging in the company. They insist upon a formal documentation where you need to be very sure on a couple of factors. Like, for example, a formal documentation of the hedging strategy should first of all ensure that you've got eligible hedged items with you. The company has identified those items which are eligible for the purpose of hedge, the list which I gave you. The company is also having eligible instruments, derivative contracts with the help of which they will do the hedging. So make sure that the items to be hedged, the instruments with which hedging is done, are eligible in nature. Secondly, they require you that you should go in for a formal documentation of your things. Get the strategy of the management clear. Why does the management want to do a hedging? What is the strategy they're going to use for the purpose of hedging? Do the documentation, because even as an auditor, when I'll go to do the audit of the company, I know one very important principle, that if the inventory is a part of the hedged item, then the inventory measurement principles is no longer governed by Ind AS 2. The inventory is going to be taken at a fair value. So unless the company gives me a documented facts about, what are they hedging, with what tool are they hedging, what is the objective of the strategy, the objective of hedging, the standard does not allow you to proceed further. And we also need to go for a little checking in terms of what we call the effectiveness of the hedge. We need to ensure that when a company is entering into hedging, we should ensure that it's going to be an effective hedge for them. Because you all know one thing, that if there is an asset and I know the value of the asset will fall down, you will always take a position in a derivative market where you get a gain. So hedging gives you the advantage that a fall in the value of the asset is coupled with a gain on the derivative instrument. An increase in the value of the asset is coupled with a fall in the value of the derivative. So you take an opposite position in a derivative market so that the gain on the hedged item is offset by a loss on the hedging instrument. The loss on the hedged item is offset by a gain on the hedging instrument. So the company also needs to make a checking in terms of effective hedge. Then finally, after the third step is done, we need to go to the step number 4. And in terms of the step number 4, you need to decide what is the type of hedge to be applied. Typically, there are 3 kinds of hedge, but from the examination point of view, we basically talk in terms of 2 hedge. One is called a fair value hedge, and one is called a cash flow hedge. When a company enters into hedge accounting, it needs to consciously decide its objective. Well, let me tell you one thing. In a same situation, 2 different companies may try to protect themselves against 2 different things. One company in a given situation feels they want to protect the fall in the fair value of the item. They go in for a fair value hedge. Another company in the same situation feels that we want to protect the cash outflows in the given situation, so they go in for a cash flow hedge. There will be no questions in the exam, and this can be a very typical exercise in terms of deciding for the company what kind of hedge is done. In the examination, of course, if you get a question, you're pretty sure that they will tell you the kind of hedge accounting we need to apply. As I said, it's not that in a given situation, only one kind of hedge can apply. Depending upon the perception of the management, what they want to protect, a company could go in for a fair value hedge, or the company could go in for a cash flow hedge. And then finally, the step number 5 is all about deciding the accounting for this hedge. Now, if you look at the examination perspective, you're not going to get identifying the hedged item or the hedging instrument, or the third parameter of seeing that the formal documentation is done, or deciding the type. The main idea is to get how does the accounting gets taken place. So what I'm going to do, I'm going to give you now the exposure in terms of accounting, that if you apply a fair value hedge, what happens? If you apply a cash flow hedge, then what kind of accounting is done? So let's, I think, begin with the accounting stage, but I guess you've got a flavor of the 5-step model so far. Okay. Kaushik, can we do the illustration number 43 in the class? 43. Okay, which illustration 43? I didn't get that. You mean on the comprehensive illustration, is it? And so he said, taking the contrary position as a hedge. Yes. When you are looking at hedge accounting, yes, we are undoubtedly looking at taking a reverse position. So that, as we said, a gain on the underlying asset, the hedged item, is offset by a loss on the hedging instrument. So we always take an opposite position in a derivative market for the purpose of conducting a hedge. Okay. Now, I think let me first of all give you exposure on how the accounting for a fair value and accounting for a cash flow hedge is concerned. Pretty simple and pretty straight. Now, first of all, let's, I think, elaborate on the concept of a fair value hedge. Now, watch this carefully. It's very simple and very straight. The accounting is not at all complicated. The complications are more on the initial 4 steps which are there. Okay, I think Kaushik said illustration of DTEP of agitating the historical cost. Okay, well, that's pretty simple. No worries. You can just have a look at that. Every theory is given out there, so no worries on that. So you'll get it. Once you read it, you'll definitely get that. Okay, now coming to the concept of a fair value hedge. So you've got a hedged item on one hand, and you've got a hedging instrument on the other hand. You've got a hedged item on one hand, and you've got a hedging instrument on the other hand. The life is very simple. See what I'm saying? It clicks in a second. Well, when you're looking at a hedged item, typically, let's say if you're looking at a financial asset, I would say the financial asset, if it is measured at FPTOCINR, or if it is measured at any other measurement base, whether it is AC or FPTPL, or it is supposed to be a case of FPTOCIR. So when you're looking at a hedged item, and the hedged item is supposed to be, you can say, an equity investments measured at FPTOCI. Where is the fair value changes taken? The fair value changes is taken in the OCI. Even if hedge accounting is done, the fair value changes will continue to be taken in the OCI itself. If your hedged item is a equity investment measured at FPTOCINR, your fair value changes on the hedged item will continue to be taken in the OCI. Rest in all the cases, the fair value changes will be taken in the P&L. Sir, you mean to say that if the hedged item is measured at amortized cost, now you are going to consider the fair value changes on that and take it to the P&L? Yes. So as I said, the measurement principles will get overruled. You can say the only measurement principle which doesn't get overruled is the equity investments measured at FPTOCINR. If your hedged item is measured at FPTOCINR, the fair value changes continue to be taken in the other comprehensive income. In all other cases, even if your financial asset was earlier taken at AC, we never used to consider any fair value changes. But now, if it is brought under the purview of hedge accounting, the fair value changes will be taken in terms of AC category also and taken to the P&L. So the basic call is hedged items will be taken at a fair value. The moral of the story is the measurement principle for hedged item is a fair value, irrespective of what you were doing earlier. Irrespective of what you were doing earlier, any fair value changes in the hedged item will be captured in the P&L. And in this particular case, the only exception is that if it was a case of equity investments being hedged, then the fair value changes continue to go to OCI because I can't afford to take it to the P&L, because the concept of no recycling doesn't allow me to take anything in the P&L. Similarly, when you look at the fair value changes in a hedging instrument, it all depends upon the hedged item only. If the fair value changes of the hedged item was taken in the P&L, the fair value changes of the hedging instrument also in the P&L. If the fair value changes of the hedged item is taken in OCI, then the fair value changes of hedging instrument will also go to the OCI. So it is, everything is dependent upon the hedged item. So the moral of the story is simple. If you look at a hedged item and a hedging instrument, the fair value changes of the hedged item and the hedging instrument ideally has to be taken all in the P&L, but there is only one exception. If you've got equity investments measured at FPD OCI, the fair value changes of the hedged item and the fair value changes of the hedging instruments, both are going to be taken in the profit and loss account. Right, friends? I guess I am pretty clear on the fair value hedge accounting. Right? So this is on the fair value hedge accounting. Now let's have a look at the cash flow hedge. So basically, you can say that once you come under a fair value hedge, you need to consider the fair value changes, and you can say the fair value changes on the hedged item, the fair value changes on the hedging instrument, everything taken to the P&L. The only exception is that if the hedged item is equity investments taken at OCI NR, then you need to consider the fair value changes in the OCI. Now, as far as a cash flow hedge is concerned, well, in terms of a cash flow hedge, what do we do? That when you enter into a derivative contract for the purpose of hedging, whatever is the fair value changes of the hedging instrument, they will be taken to what we call OCI. So we can say that if a company uses a cash flow hedge, then there are fair value changes of the derivative instrument, the hedging instrument which you have entered into, the fair value changes of that instrument will be taken in the OCI. And you know that whatever enters the OCI is also taken in the statement of changes in equity. And if you remember, it's going to be taken in the tab number 3 of SOCI, which I did the discussion long time back in some class. So you're going to take that amount in SOCI, and this amount is going to be called as CFHR, cash flow hedge reserve. So the company is going to accumulate the fair value changes in the other comprehensive income, and it will be accumulated in the statement of changes in equity in tab number 3 under the heading, under a nomenclature called a cash flow hedge reserve. Now, let me tell you one thing. There is another input which we need to keep in mind. When a company applies the concept of a cash flow hedge, the standard further says that you need to decide that there is an effective portion of a hedge accounting and there is an ineffective portion of the hedge accounting. There is an effective and ineffective portion of a hedge accounting. The effective portion of the hedge accounting is taken to the OCI and the ineffective portion is taken to the P&L. Now you would say, sir, how would I decide that what is the effective and the ineffective portion of the hedge? Very simple. I'll tell you. You look at the hedged item, and see what is the change in the cash flow. See what would be the change in cash flow. Let's say, for example, if you want to buy a machine, if you were to bought the machine today, what is the cash flow? If you want to buy the machine 6 months later, what is the cash flow? So look at the change in the cash flows in the hedged item, and then look at the change. Look at the change in the cash flows of the hedging instrument. Look at the change in the cash flows of the hedging instrument as well. So look at that if the cash flows would have taken place today, and if the cash flows are going to take place later, compare the two. If the change in the cash flows of the hedged item is greater, then we say the hedge is effective. So let's say if this change is 120 and this change is 100, we say the entire hedge is effective. And if you say that this is 100 and let's say this is 120, we say it has got an effective portion to the extent of 100. And we will say the ineffective portion is 20. I put that again. So what do you need to do in this particular case? In order to decide in terms of cash flow hedge, you need to see that what is the change in the cash flows of the hedged item. You need to see the change in the cash flows of the hedging instruments. Compare the two. If the change in the cash flows of the hedged item is greater, it means the entire hedge is effective. You can put every change in the hedging instrument in the OCI. But if the change of the cash flows of the hedge item is less, it indicates that in this particular case, it is a combination of effective and ineffective hedge. Though there is no illustrations given on what I'm telling you, but I'm just giving you a broader idea of hedge accounting. The question which came in RTP was pretty simple. All the amount of change was taken to the cash flow hedge reserve itself. But I'm just giving you a little extra input that you need to decide effective, ineffective portion. So once you decide that it's an effective hedge, everything enters the OCI. But if you decide it is ineffective, the effective portion goes in the OCI and the ineffective portion is taken in the P&L. So this is how the accounting for a cash flow hedge takes place. And then finally, when the asset is going to be purchased, for example, the entire amount in the cash flow hedge reserve will get adjusted against the asset value. So the company, let's say, enters into a cash flow hedge for the purpose of buying a machinery in the future. So when they're going to enter into a contract to buy a machinery in the future, in that particular case, what they would do, they would enter into a derivative contract. So any amount which is accumulated in the CFHR ultimately is going to be adjusted against the value of the PPE when it's going to be finally purchased. So this is how the accounting for a cash flow hedge takes place. So I've given you a theoretical idea in terms of how the accounting is done, except for one illustration in the RTP study material has not taken any illustrations on that, but I've still given you a fair idea of how you can tackle a fair value and a cash flow hedge. So that finally, brings us to the end of our marathons on financial instruments. It's been almost around 9 sessions with you on financial instruments, very enjoyable to me as well. But there's no dearth of getting into more details. But I think time is limited, and of course, I think we need to concentrate from the examination point of view. I hope we've tried to justify the maximum whatever we could do, and I hope you've been able to get much inputs in terms of financial instruments. But I think the need of the hour is now that you should sit down and do a cumulative revision of the entire financial instruments in a go. I guess you may not be having a session tomorrow, so I think you can take out some time this weekend on Saturday and Sunday, sit down and do this entire financial instruments revision in entirety. Go through the illustrations of the study material, then try the questions from the examination papers and the RTPs and all, and I'm pretty sure you're going to get a good hang of this particular subject. Right, friends. So I think that's all for the day. If you've got any questions, you can come to me. I think Shobham said, "Sir, it's really creditable to you to take such a heavy index in these 9 classes which were taken. Thank you very much. We'll revise the chapter fully." Thank you, Shobham. That is really sweet of you. So I think any more questions coming in? That's really sweet of you. Thank you so much. I know justifying a topic, bigger topic like this takes a toll, not only on me, but I think it takes equally a pressure on the students as well to appreciate that kind of thing. Koshki, so it was wonderful sessions on financial instruments. Thank you so much. Nidhi, so thank you so much. All the lectures were really amazing. Got to learn a lot from you. I hope to see you in future as well. Not in this month. Let's see if I am engaged for the next month or something. So maybe hope to see you again in the future as well. So on that wonderful learnings, I think it's time to say goodbye to all of you. So thank you so much, friends. And thank you, Sumit, as well. Thank you so much. So, and Shirendra, thank you. And Kaushiki, can you please share your contact number? No, if you've got any queries, you can mail it to the ICI email. I would not be able to share my contact numbers. We can't do that. So you can send those queries. They would be forwarded to me. So in case you've got any queries, you're most welcome to do that. Right, friends. So on that note, I take leave from you. So thank you. Bye-bye and take care. Thanks, Rashmi. Thanks, Shobham. Thank you, all of you.